Hi friends, a small intro video before you see the main video. Uh, these are concept revision videos for AFM, costing or FM. Objective is very simple. Learn concepts with limited amount of time. Post concepts, do practice. These are applicable for first time learners as well as new learners, and these are taken from my regular or exam oriented sessions. Now you move to the main video. Okay, now we move to the main set of chapters. We're going to start with chapter 4, which is called cost of capital. I'll first set the initial context of the chapter. Chapter 4, 5, and 6 together is like a single chapter and has a weightage of around 25 out of 60 marks. 60 marks is the paper, including the choice set of question. So this 4, 5, 6 combination is almost 40% of your paper. 60-65 marks is the overall paper. So 35 to 40% is the weightage of this segment. Now, what is this segment? Let's first understand. We learned that FM has basic two things. One is money is to be raised. Second, you have to invest it and earn out of it. When we raise money, whatever forms you raise money, you need to pay something to the people from whom you're taking the money. For example, if you take loans, you have to pay interest. If you take preference capital, you have to pay preference dividend. If you take equity capital, you have to pay equity dividend. So wherever money is taken, we need to pay something. We need to pay something. It is not free money kind of a concept. So money needs to be paid to the providers of capital. In this chapter, we are going to learn what is the money we are paying to the people in percentage, in some percentage. Somebody will say the cost of capital of my company is 12%. What is 12%? Is on an average, I pay 12% on the amount taken from the people. The money can be taken in the form of equity, money can be taken in the form of debt, money can be taken in the form of preference. Debt you could be paying some 10%, equity you could be paying some 14%, preference you could be paying some 11%. On an average, it is 12%. The objective of the chapter is to understand what are we paying to the providers of capital. Once we understand what we are paying, we move to chapter 7 after doing this segment. There we will understand what we are earning on the investment. Two aspects. One aspect is raising of money. Second aspect is investment of money. Raising of money will be in multiple forms, and I want to calculate what is the cost. What is the cost I pay for raising of money? What is the cost I pay for raising of money? After the cost I pay for raising of money is understood, I invest it and understand what is I am earning out of the money. What I am earning out of the money. So capital in FM means long term money. What is long term money? Is equity, debt, preference. So there's a word called debt capital. Capital means debt is also part of capital only here. Debt is also part of capital. Preference is also part of capital. When you go back to costing, in cost sheet chapter would have learned interest related to non-long-term funds or non-equity funds. Long-term funds means capital. Long-term funds is term capital. So debt is also capital. Preference is also capital. Equity is also capital. Equity can be of two parts there. External equity and internal equity. External equity is called equity shares. Internal equity is called retained earnings. Internal equity is called retained earnings. We can have two types of equity, external equity and internal equity. External is called equity shares. Internal is called retained earnings. Now, I am going to understand what is the cost of debt first, then understand what is the cost of preference, and ultimately understand what is cost of equity, cost of debt, cost of preference, cost of equity in this chapter. That's the objective of the chapter, to understand what is cost of debt, what is cost of preference, what is cost of equity, and then a weighted average will be done, and you'll say overall cost of capital is equal to so much. Why are we learning this? If cost of capital is 12%, my return which I do on the asset side, return on capital employed or return on assets purchased, should be more than 12%. Should be more than 12%. That is the objective. Okay. In the context of that, First thing we are going to learn is cost of debt. Now, let us understand some basic information about debentures. Debentures can be of multiple types you have. For our problem solving, three types are there. One is called redeemable, second is called irredeemable, third is called convertible. Redeemable, irredeemable, and convertible. I have other types and all. I'm not getting into those types as of now. There's a redeemable debenture, there's a irredeemable debenture, there's a convertible debenture, secured, non-secured, all that I'm not bothered. For our solving purpose, either it is a redeemable debenture or an irredeemable debenture or a convertible debenture. Next thing I need to be aware of is the concept called face value. What is face value? The value written on face of the instrument. Whenever you buy debenture, some certificate will be given to you. That certificate will have a value written on that. That is called face value. That value written on the instrument. Why is this critical? Face value 100, market price 120, issue price 110. Interest will be paid only on 100. Interest will be paid only on 100. You can't say I paid 150 rupees, you pay interest on 150. Nothing doing. Face value only, interest will be paid. Face value only, interest would be paid. You could be buying a debenture for 120 rupees, 130 rupees, 140 rupees, 150 rupees. Or when I issued the debenture at a premium, 20 rupees, 30 rupees, 40 rupees, whatever said and done, interest will be paid only on face value. Interest will be paid only on face value. Any doubts till this? Then coupon rate means the interest rate on the bond. The coupon rate is interest rate on the bond, and as I said, interest will be paid only on the face value. Interest will be paid only on the face value. Whatever be the interest rate, interest is going to be paid only on what? Face value of the instrument. If problem is silent, we take it as 100. If it gives something else, please write whatever is the face value. Interest is paid. Interest is paid only on what? On the face value. Interest is paid only on the face value. Any doubts till this? Interest is paid on the face value. There is something called as issue price and redemption price. Issue price taken as par value, redemption taken at par if problem is silent. Otherwise, can be premium, can be discount. Your company's act may have certain rule. I'm not bothered all of that. FM is universal. Universal means it is done for all companies. So concept is very simple. Your issue price or the redemption price, the issue price or the redemption price will be taken at par if the problem is silent. If they give something else, please follow it. I'll repeat again. Three types of debentures are there. Redeemable debenture, how do we calculate cost? We will understand. Irredeemable debenture, redeemable as the name indicates, there is a fixed life. Irredeemable means no life. Convertible means again limited life will be there, but it will be converted. It will be converted into equity. It will be converted into equity. Redeemable is there, irredeemable is there, convertible is there. Redeemable, no, redeemable has an end. Irredeemable, no end. Convertible means it has an end and will be converted into equity. It will be converted into equity. Face value, nothing given, take it as 100. Coupon rate, interest rate of the bond. Issue price and redemption price at par if problem is silent. Otherwise, it can be at premium, it can be at discount. Can be at premium or can be at discount. Interest is face value into the coupon rate. Clear? Any doubts on this? Okay. Now, I want to calculate cost of debt. This is called KD is called cost of debt. KD is called cost of debt. I want to calculate. First, we are going to understand something called as irredeemable debt. Irredeemable means there is no end. Irredeemable has no end at all. Irredeemable has no end at all. What is cost? Cost is very simple. You give me 1 lakh rupees. I pay you every year 5,000 rupees. I pay you every year 5,000. 5,000 on 1 lakh is my cost. I pay you 5,000 every year. What is cost? What I pay you every year and I get some amount from you. When I take a loan from a bank, every year I have to pay something. But the loan will have a specified end. First, I am talking about an irredeemable. Irredeemable means no end. Irredeemable means no end. So, cost of debt is nothing but interest in rupees. Interest in rupees. Interest in rupees means what? Face value multiplied with the coupon rate. Face value multiplied with the coupon rate. Interest in rupees divided by net proceeds in rupees. What is net proceeds? Is what I collect from you today. What I collect from you today. You paid me 1 lakh rupee. I pay you 5,000 every year. I pay you 5,000 every year. One benefit of debt is whenever I pay interest under income tax, interest is a tax deductible expense. You learn this in income tax, but interest is a tax deductible expense. Because of this, what happens? I pay you 5,000, but I'll get some tax saving from the government of India. So whenever we pay interest, we multiply that with 1 minus tax rate. We multiply with 1 minus tax rate. What is 1 minus tax rate? Is the benefit which I get from the government every year. The benefit which I pay you 5,000. Immediately what I'll do is I debit this to the P&L. If you debit to P&L, profit goes down, tax goes down. Profit goes down, tax goes down. Whereas if you pay equity dividend can't be debited to your tax P&L. That you'll understand as we proceed. Interest can be debited to the tax profit and loss account. There's a tax profit and loss account, normal profit and loss account. Under income tax, interest can be debited. Once you debit interest, profits go down, taxes go down. Profits go down, taxes go down. So cost of debt is equal to interest in rupees. What is interest in rupees? Face value multiplied with the coupon rate. Question may say we have 5,000 debenture. I'll do only one debenture. One debenture calculation is sufficient. You can do 5,000 also, same number you will get. Interest in rupees multiplied with what? 1 minus tax rate. This is also called as interest after tax. It's also called interest after tax divided by net proceeds. Now let's understand what is net proceeds. I'll first explain. Cost of irredeemable debt is interest in rupees, whatever I pay every year, into what? 1 minus tax rate. Why 1 minus tax rate? It's a tax deductible expense. Divided by net proceeds in rupees. Net proceeds in rupees. What is net proceeds? Let us understand. Net proceeds means what company collect. What company collect. Now, net proceeds can be calculated in two different scenarios. What is two different scenario? Bond is, everything is there in the book. Understand only, nothing for you to write down. If something is extra, I will tell you to write down. I'm not showing you the book. First, I'm explaining, then I'll show in the book. Bond is issued today, or bond was issued earlier. Bond could be issued today, or bond is earlier issued itself. Bond is earlier issued itself. Net proceeds means what company collects. What company collects. If you issue today, you will collect issue price minus flotation cost. Don't look at the book as of now. Nothing for you to look at the book. Understand, issue price minus flotation cost. What is issue prices? A 100 rupee bond. I issued for 110, 120, 90, 80, 70 that I collect today. Minus flotation cost means whenever you issue any bonds, debentures or equity shares, there can be some underwriting requirement, there can be a prospectus requirement, there can be a merchant banker requirement. Some expenses you may incur on that. That is called flotation cost. Whenever you want to raise money, for example, today you go and take a bank loan, he will charge processing fees. That processing fees is called flotation cost. I raised 20 lakh rupees, but in that 20 lakh, 1% is out. What is 1% out? I have to pay flotation cost. So if bond is issued today, issue price minus flotation cost. Bond was issued earlier. Earlier means you have already done the issue sometimes back. Today I can't get any money. Today obviously I can't get any money. So what FM says is, in case if you issue the bond today, it's already issued. But in case if you issue the bond today, you will earn current market price. No flotation cost and all, because there can be flotation cost, but I can't assume and all. So bond you are issuing today, issue price minus flotation cost. Bond was issued 10 years back. Today I want to do the calculation. Why I want to do the calculation today? Because every year you have to do the WACC or cost of capital calculation. Every year I have to do cost of capital. Now I cannot say I issued 10 years back, so I don't have any denominator. That is not logical. Without denominator, cost will become infinity. So denominator is needed. If you do issue today, issue price minus flotation cost. If you have already done the issue and you want to calculate today, use the current market price. Wherever possible, we try to do this type of calculation. What is this type of calculation is, even if it was issued earlier and they say today if the bond is issued, issue price will be 20, flotation cost will be 1, we'll do 20 minus 1 in the denominator. Wherever feasible. If no feasibility is there, then our preference goes to current market price. What is current market prices? Today if I issue the bond, people will pay 110, 120, 130, whatever is the market price. Can there be flotation cost on this also? Yes, but I can't assume anything now because I don't know what will be the flotation cost. I'll repeat now. First is cost of debt. What company pays every year divided by what company gets on day 0 divided by what company gets on day 0. For example, I took a housing loan. I took a loan of 1 CR, no end, perpetual loan. 1 CR loan, every year I pay 10 lakh rupees. Every year I pay 10 lakh rupees. 10 lakh divided by 1 CR is my cost. 10 lakh divided by 1 CR is the cost every year. Every year you have to pay 10 lakh. There is no end. There is no end. I'm talking about irredeemable as of now. I'll come to redeemable in some time. So irredeemable debt, interest after tax divided by net proceeds. What is interest after tax? Interest in rupees into 1 minus tax rate into 1 minus everything is there, nothing for you to note down. I'll tell you if at all some points are not there. What is interest after tax? It is mentioned here. Interest into 1 minus tax rate. Interest into 1 minus tax rate. What is interest? We have already explained here. Face value into coupon rate. Interest is face value into coupon rate. Clear? Any doubts on this? Interest after taxes, interest into 1 minus tax rate. Denominator, I want to use net proceeds. New issue happening today. New issue happening today. Issue price minus flotation cost. Issue price minus flotation cost. New issue not happening today. Already done in the past. Current market price. Logic issue will happen today and company can collect that today. Company can collect that today. This is for irredeemable. This is for irredeemable. What is irredeemable debt is? Interest after tax. For example, I am issuing a 10% debenture, face value 100, issue price 110. Issue price 110. Flotation cost 2 rupees. Flotation cost is 2. I am going to issue today. What is cost of debt? KD equal to interest after tax by net proceed. Interest after tax by net proceed. What is interest after tax? Interest into 1 minus tax rate. Interest into 1 minus tax rate. Interest into 1 minus tax rate. What is interest? Face value into coupon rate. Face value into coupon rate. That is 100 into 10%. 100 into 10%. Face value into what? Coupon rate. Face value into coupon rate. 100 into 10%. This is interest. Multiply that with 1 minus tax rate. Multiply that with 1 minus tax rate. Multiply that with what? 1 minus tax rate. I am assuming, let's assume tax rate is 30%. Okay, just for discussion sake. Okay, 100 into 10% into 1 minus 0.3. Net proceeds is issue price minus flotation cost. Issue price minus flotation cost. If you are issuing today, denominator is 110 minus 2. Denominator is 110 minus 2. So what will happen? Numerator will be 10 into 0.7 by 108. Final answer we will do into 100 to express in percentage. To express the answer in percentage, we'll do into 100. You don't want to express in percentage, decimal into 100 is not needed. We normally express in percentage, which is 7 divided by 108. We are paying 6.48%. We are paying 6.48%. This is called irredeemable. Irredeemable means there is no end. Irredeemable means there is no end. Any doubts till this? Next comes redeemable debt. Redeemable debt. Let's understand what happens in redeemable debt and then we go through the concept. Irredeemable, I have made you understand. 10 into 0.7 by 108, 6.48%. We have got the number. Now comes the redeemable debt. In redeemable debt, what happens? Let's understand. Redeemable debt will have a life. Will have a life. Now, what can happen in redeemable debt is interest 10%, face value 100, issue price 110, flotation cost 2, and there will be a redeemable value. There will be a redeemable value. What is redeemable values? After 5 years, 10 years, 15 years, 20 years, you will pay back something. Redeemable value is 120. Redeemable value is 120. Life is 10 years. There's an end to this. There is a end to the life year. Life is 10 years. Earlier, there was no end. It was a perpetuity. Here, there is an end. End is life is 10 years. Interest 10%. Face value 100. Issue price 110. Flotation cost 2. Redeemable value 120. Life is 10 years. Now, how will I do calculation here? Let's understand now. First thing is I have to pay interest every year. I have to pay interest every year. Interest is paid on what amount? On the face value. Face value is how much? 100 into 10% into 1 minus tax rate. Tax rate taken 30%. Okay. Denominator is something else here. What is that? And I'll explain in some time. Along with this, I may pay something more to the debenture holder. What do I pay something more? Listen. When I collect money from the people, I collected 108. I collected 108. When I return this money, I should pay only 108. When I return the money, I should pay 108. But I have to pay how much? 120. This is an extra cost for me. This is a, like interest is paid. I'm paying what? I collected 108 from you. I'm paying back how much? 120. I collected only 108. The flotation cost, whatever be the reason, I collected 108. I'm paying you back how much? 120. So I pay, listen, 120 minus 108. This is the expense over a period of 10 years. This is an expense over a period of 10 years. So they say divide by 10 because we are doing yearly calculation. We are doing yearly calculation. I'll come to the formula and all in some time. I'm paying you back how much? 120. I collected how much from you? 108. Divide this by 10 years. Divide this by 10 years. Why are we dividing by 10 years? Because interest is every year. This also let us do every year calculation. Let us do every year calculation. What is this 120? I paid you back 120 at the end of how many years? 10 years. How much I collected from you? 108. 108 collected. Paid back 120. 120 minus 108. 120 minus 108 is an extra expense of 12 rupees for a 10-year period. 12 rupees for a 10-year period. 12 rupees for a 10-year period. In this part, we normally don't do into 1 minus tax, but one exam question they specifically mentioned saying that this part also tax deductible. This part also tax deductible. Tax deductible means into 1 minus t will also come for this. Into tax deductible means your expense will go down. Expense will go down. Government of India on housing loans give tax benefit to people. So why? Because I want people to take loans, buy house, so that the housing sector improves, and indirectly this tax benefit is the reason people take loan. Tax benefit is the reason people are taking loans. So interest we get tax benefit. This extra cost we may get tax benefit, we may not get. Normally no benefit on this. Normally no benefit. So this into 1 minus t will not come here. But one exam question specifically said do into 1 minus t. Into 1 minus t. Any doubts till this? Divided by what I collect from you and what I give back you average. They say take average. Take average. What is average? I give you back 120. I collect 108. On an average, take the value. Why average? Why not 108? Can be done 108 also, can be done 120 also. ICAI says take average, and this formula is called approximate method. Then what is the real formula and all, I'll explain sometime. This is approximate. Problem silent, we do approximate only, we do approximate. I don't want to answer, understand the calculation. What is the calculation? First I have to pay face value into the interest into 1 minus tax. Face value into the interest into 1 minus tax. Extra I pay 120 minus 108, but divide by 10 years. 120 minus what? 108 divided by how many years? 10 years. 120 minus 108 divided by how many years? 10 years, whole divided by 120, 108 average. 120, 108 average. Why not denominator use 108 like we used earlier? Net proceeds can be done, but this is approximate formula. Formula says take average of opening value and closing value. Take average of opening and closing. Somebody says calculate cost of debt on the closing value, then denominator will be 120. Calculate cost of debt on the opening value, denominator will be 108. None of that has been tested in exam. Only thing we will take in the denominator is average of the two. What is the average? Is 120, 108 by 2. Now comes our formula. Formula is interest after tax plus average approximation method. There's another method. What is that? I'll explain. Interest after tax, average other cost divided by average funds employed. Average other cost is redeemable value minus net proceeds divided by balance life. Redeemable value minus net proceeds. What is redeemable value in my example? 120. Net proceeds 108. Life is 10 years. 120, 108, 10 years. Average funds employed, redeemable value, net proceeds by 2. Redeemable value, net proceeds by 2. Any doubts till this? There's another method which I'm not touching as of now. Redeemable value, net proceeds by 2. Any doubts in this? I'll repeat the formula. Don't try to remember the formula. That is of no use. Okay. First is cost of irredeemable debt. Or the formula is very simple. What company pays every year divided by what company gets on day 0. This is the formula. In irredeemable debt, this formula will directly work. What company pays every year is interest into 1 minus tax rate divided by net proceeds. In case of redeemable, we have an approximation method which says you pay interest every year and you pay average other cost. Very rare scenario. Average other cost can be negative also. Negative means redeemable value 100, net proceeds 120. Redeemable value 100. I collected 120 from you, but paid back only 100. Paid back only 100, which means I save money. I save money. Rare scenario. Your average other cost can be negative also. Redeemable value minus net proceeds divided by balance life, and redeemable value plus net proceeds by 2. Redeemable value plus net proceeds by 2. Any doubts on the formula here? Any? Yeah. Okay. The reason for average other cost is when I record in my balance sheet. Okay. I have to record the debentures in my balance sheet. Debentures were issued for 110 rupees. So I may record the debenture at 110 or 100 face value, whatever. Okay. Ignore that face value part. 110 is the face value. Let's assume you recorded at 110. When you recorded 110, 2 rupees went to P&L. What is 2 rupees? Your flotation cost. When you return, this 110 is returned as 120. You pay another 10 rupees. 10 plus 2 put together, you pay 12 rupees, which will go to P&L account. 12 rupees will go to P&L account over a period of 10 years. Over a period of 10 years, 12 rupees will go to P&L account. What accounting may tell you is, instead of taking it like in the end, maybe every year let us amortize it. Every year let us amortize. What is every year amortization? This 2 rupees every year 0.2, every year 0.2. Extra 10 rupees you pay every year 1. So instead of saying 12 rupees extra for 10 years, I am saying 1 rupee 20 paise extra every year. 1 rupee 20 paise extra every year. What is this extra? I am returning 120. I collected 108. This extra 12 rupees will go to profit and loss account, will go to P&L account over a period of 10 years. Every year is 1.2. Yeah, tell me, you still look confused. Debenture holder. Redeemable value means you are the investor. I have to pay 120 to you. I collected 108 from you. How did I collect 108? You paid 110, but I collected only 108 after flotation cost. So 120 minus 108 is an extra expense for me. That is a extra expense for me. On this extra expense, you will have a scenario called tax benefit, no tax benefit. Problem silent, we don't take any tax benefit angle. One exam question specifically said there is a tax benefit. If there is a tax benefit, into 1 minus tax rate, into 1 minus tax rate. There's a doubt online. Can the redeemable value be less than issue price? Yes, it can be. It can be issue price. Then you will have to subtract the amount in the calculation. When I say subtract, formula is same. It will become minus. It will become minus. Any doubts on the concept here? Any doubts on the concept? There's another part which I have to explain in some time. Okay, this is what is there in the book. Cost of debt, what company pays every year, divided by what company gets on day 0. Irredeemable debt, interest after tax by net proceeds. Redeemable debt, IRR method, leave it. Approximation method, interest after tax plus average other cost divided by average funds employed. Average other cost is equal to redeemable value minus net proceeds by balance life. Average funds employed, redeemable value plus net proceeds by 2. Net proceeds, what company can collect from its investor. New issue happening today, issue price minus flotation cost. Issue already happened in the past, current market price, with the logic that at the current market price, I may be able to issue new debentures today. I may be able to issue new debentures today. Any doubts on the concept? IRR method is still pending, which I'll discuss. Any doubts till this? Can we proceed? Understood till this? One way of doing the analysis is called approximation method, where there is an interest after tax, there's an average other cost, and you divide by average funds employed. Another thing which can happen is, excuse me, I issued debentures now. Let us assume we are issuing debentures, year, cash flow. Debenture was issued for 95 rupees. So an investor paid 95, our company received 95, whatever way you want to call. Let us call it as minus 95. What is minus 95? Somebody paid 95. Somebody paid 95. First year, company will have to give 7 rupees back. What is 7 rupees back? Is interest into 1 minus tax rate. Second year, again it will give 7 rupees back. Third year, again it will give 7 rupees back. Fourth year, again it will give 7 rupees back. Fifth year, it will give 7 plus 100, 107. This is what the company is giving. What we used to do in this scenario is interest after tax by average other cost divided by average funds employed. Interest after tax is 7 rupees. Average other cost is redeemable value minus net proceeds by balance life. Redeemable value is 100. Net proceeds is 95 divided by life, and then used to do RV plus NP by 2 and then close the question. That is approximate method. Now there's a second method called detailed method or YTM method, yield to maturity method, or IRR. Basically what I need to do is this total of this should become 0. The total of this, can you put a total and tell me what is the total you are getting here? What is the total you are getting here? Can you just put a total? 40. But I want to get the total as 0. How can I get total as 0? By discounting this. By discounting this, because these are a different time period. If you discount at 1% and you get the total 0, 1% is the cost you are paying. If you discount at 2% and get the total 0, 2% is what you are paying. See, I issued the bond at 95. Bond is paying interest 77777 and redemption is at 100. Redemption is at 100. Net proceeds 95. Redemption value 100. Can you give me the approximate method answer? Right? Do the approximate method and tell me the answer. Interest after tax plus average other cost by average funds employed. Interest after tax is 7 rupees. Average other cost is 100 minus 95. 100 minus 95. 5 years. 100 minus 95, 5 years, divide by 100 plus 95 by 2. 7 rupees interest I pay every year after tax, 100 rupees redemption value, 95 rupees is net proceeds. 100 minus 95 by 2. Minus, I'll come to it in some time. You just first tell me this one. 8.21. Listen, in any instrument, there will be an inflow, there will be an outflow. Always, any instrument you take. You can say the cash flow is like this also. What is this is? Company received 95. 9 received means plus. Paid 7, paid 7, paid 7, paid 7, paid 107. Paid 7, paid 7, paid 7, paid 7, 107 in the end. What is 107 in the end? 7 rupee interest, 100 rupee principal. I told you do approximation method. What is approximation method? Same logic. Approximation is cost of redeemable debt is equal to interest into face value into 1 minus tax rate. Interest is 100. Interest is 10%. Face value is 100. Tax rate is 30%. So you got 7 rupees. You got 7 rupees. Redeemable value 100. Net proceeds 95. Life is 5 years. 100. 95 by 2. You told me an answer. What's the answer you got? 8.21%. Now, if I discount this at 8.21%, if I get 0, then effectively it means that for raising that 95 rupees, I have paid 8.21% every year. I have paid 8.21 time value of money, discount at 8.21%, total should become 0. If total becomes 0, it means you received 95, paid back 77777 If you discount that 7777107 means we have paid more. But if I discount this at 8.21%, why did I pay more? Because I am repaying it over a period of time. If you get 95, immediately pay 95, no interest. So I am paying back 7. I will discount it at 8.21% or 8%. I want to get the total as 0, which is not possible. Exactly 0 and all is not possible for us to do. How do we get to the answer and all? We'll understand in some time. But the concept is very simple. You paid me 95. I paid you 77777 You can write cash flow like this. This is cash flow of company. This is cash flow of investor. Both are okay. Investor means he will say I paid 95, received 77777 Objective is very simple. The 95 today's value, present value of 77777 should also be 95. When will it be 95? Could be at 8%, could be at 9%, could be at 8.5%, could be at 9.5%, could be at 9.25%, could be at 9.15%. I don't know what rate. If you can get that rate, that is the cost of debt. That rate is called the cost of debt. How do we get to that rate and all? We'll understand in some time. But concept is very simple. You are collecting 95, paying 7777 and 107. Or 5 years 7 and extra 5th year 100 rupees. Extra 5th year 100 rupees. Only problem here is when I am doing this calculation, I want to know what should be the discount rate so that total matches 0. Total matches 0. How will the total match 0 is what we are trying to understand. How will the total match 0? If we are able to get a 0, it means present value equal to sum of the future present values discounted. If both are equal, it means you have extra paid 7%, 8%, 9%, 10%, 11, 12, I don't know. I'll have to do that calculation. This is what the concept is. Earlier what we were doing, we were just applying a simple formula. Now, if I discount this at 8.21%, I may get 0, I may not get 0 also. For example, I'm discounting this now at 8.21%. Ideally, we will not get 0 because that is an approximation method. How do we do discounting? Is year, cash flow, PVF, DCF. We had a year 0 where 95 was the outflow of the investor or 95 is the inflow of the company. You can call it as outflow inflow. 107. I am discounting this at 8.21%. PVF at 8.21%. And see, if I put a total now, I get 40 rupees. If you discount and put a total, you may get a 0. You're just trying to find at what rate should I discount so that I get total 0. Is it easy for us to identify? No. 8.21 is not going to be the answer. So where will the answer come? We'll understand in some time. But I want to put a total. Total should give me what? 0. How will I get 0? I don't know. I am going to explain that in some time. So I do 8.21%. First year 1 divided by 1.0821. Second year, third year, fourth year, fifth year. And year 1 there is no discounting. You multiply the 2. And if you put a total here, you are getting total as, okay, exactly 0 we are getting, which is surprising. 0.20. 0.20, which is almost 0. I want exact 0. Exact 0 could be 8.25. Could be some other number. I don't know. We are trying to find that answer. What we do in the formula is approximate answer. Exact answer you want, practical world, this will be done. Why don't we do this for every question? This is a time consuming exercise. So ICAI very rarely asks us to do YTM method or IRR method. Problem silent, interest after tax, average other cost by average funds employed. In case they specifically say IRR method or YTM method, the name is called YTM, yield to maturity. Yield to maturity. Listen, I did 8.21. 8.21. I'm not getting exact 0. Maybe I try 8.25. 8.25. I get 0.04. 8.25. I'm getting 0.04. Maybe 8.26. 8.26. This is not possible for you to do so many scenarios. What will you do? I'll explain in some time. 8.26. I'm getting exact 0. I'm getting exact 0. Approximate answer 8.21. Exact answer 8.26. Exact answer is 8.26. How are we going to get to an exact answer is what we are going to understand. How are we going to get to an exact 8.26? Exact 8.26. Obviously not possible for you to do like this, changing number and seeing whether you get a 0, because I can do anything in Excel. I can do anything in Excel. I can do 8.25, 26, 27, 28, 29, 30 till I reach a 0. I'll keep doing it and ultimately get the 0. In your notebook, how are we going to get to it is what we are going to understand. But the concept is this, that if you put a total here, you get some number. Now, I wrote minus 95. Somebody says, no, I will not write minus 95. I will write 95 minus 7, minus 7, minus 7, minus 107. Doesn't matter. The total will still be 0 only. The total will be 0 only. Whether the plus number you write first and minus number later, or minus you write first and plus number later, doesn't matter. Doesn't matter. Our objective is to ensure DCF total becomes 0. DCF total becomes 0. How can I reach DCF 0 is what we are trying to find here. How can I reach DCF 0? What is this purpose, or what is this exercise? This is exactly we learned in time value of money. Here what is happening is you paid me 95. This is my inflow. I pay you 7,777,107. When I put a total, I get minus 40. This minus 40 is my expense over a period of 5 years. Minus 40 is my expense over a period of 5 years. This will go to debit side of P&L. But I want to know the annualized cost every year. One simple approach we had is interest after tax, average other cost by average funds employed, which gave 8.21. Almost got the answer. But I say, no. You get me the YTM method or IRR method or accurate method. YTM method or IRR method or accurate method. I said, okay, I'll do YTM IRR. What I need to do here is I need to discount at some rate, which gives me total 0. Again, making it very clear, getting 0 total is not easy. Here we got some 0.20. Sometimes you will get 10 rupees, 15 rupees, and then you have to bring it to 0. How do we bring it to 0? You will understand when I do the question. But objective is to bring the total to 0. Somehow bring the total value to 0. How do we bring this total value to 0? is what we are going to understand in our workings, and somewhere we'll get clarity on that. Understood the concept till this? Any doubts first till this? Any doubts on this? Okay. Listen. This is what the concept says. Cost of redeemable debt using IRR, YTM. Come to page 17. Maybe write the full form alone. YTM is yield to maturity. IRR, anyway, you learn it in another chapter. So don't worry about writing the full name now. Yield to maturity. Yield to maturity. Yield to maturity. Yield means, yield is return for the investor. So return of the investor, see, listen, when I say cost of debt, you are the investor, you will say return on debt. You are earning, for me it is cost. For me it is called cost. For you it is called earning. Now listen, day zero, inflow for the company, outflow for the investor. We do investor cash flow and calculate, okay? Inflow for the company, outflow for whom? For the investor. Year 1 to life, outflow for the company, inflow for the investor. One guy will have outflow on day zero, series of inflow. Or one guy will have inflow today, series of outflow. Our objective is outflow total present value should be equal to inflow total present value. Outflow total present value should be equal to what? Inflow total present value at some discount rate. At some discount rate. Every year interest after tax, end of year redemption value. Consider cash flow and compute IRR. Consider cash flow and compute IRR. That discount rate is called IRR. Why it is called IRR and all in some other chapter. Let's not worry as of now. But objective is very simple. Can you tell me a discount rate which brings the value to zero? Which brings the value of DCF. Value of DCF. DCF is discounted cash flow. Value of DCF to what number? Zero number. I want the number to be zero. Any doubts first on the concept here? Any doubts till this first? Okay. Give me a minute. Okay, let's come to 8 itself. Or I'll give you an example. I don't want to do this question as well. Let's come with an example. Cost of debt. Cost of redeemable debt using YTM/IRR method. YTM/IRR method. Issue price rupees 90. Issue price 90. Redemption value rupees 110. Issue price 90, redemption value 110. Redemption value 110. Life 5 years. Interest rate 10%. Tax rate 30%. First do the shortcut method and give me the answer. Shortcut method or approximation method. Cost of redeemable debt. Our normal formula. Write the formula and get the answer first. Face value not given. 90, 110 means 100 can be the face value. Face value is normally 10, 100,000. Looking at the value, 100 is the face value. $100 is the face value. getting 11%. This is shortcut method are called as approximate method, and this is our preferred method always because easy to do, less time consuming. Doing IRR method, Excel is easy, but for us it could be a challenge. Any doubts on this? Can we proceed? Cost of debt using YTM method. YTM, IRR, detailed, accurate, whatever name we want to give. Using YTM method. I'll need 8 columns, open 4 columns in it. Totally 8 columns are needed. Don't open extra columns, leave space. Don't open the extra columns. First 4 columns, year, cash flow, PVF at 11%, DCF. Present value factor at 11%, discounted cash flow. I am checking whether 11% can give me a zero total. Why zero total? Zero total means inflow equal to outflow and the extra interest paid is 11% because we are discounting the number at 11%. If you discount at 11%, you are paying extra 11%. The 11% is the rate of interest we earlier learned in the time value of money chapter. Year 0. How much will the investor pay on year 0? 90, negative 90, negative 90. You can do company calculation, you can do investor calculation. I normally do investor calculation. Negative 90. Write along with me, don't write anything else, okay? Minus 90. You can write plus 90 also, doesn't matter. In the end, I want a zero total. Whether you write plus minus, minus plus, doesn't matter. Every year, what is the interest after tax we pay? 100 into 10% into 1 minus 0.3. How many years is the life? 1 to 5 annuity. 7 rupees. 1 to 5 annuity. 1 to 5 is an annuity. 1 to 5 is an annuity. Clear? Then at the end of year 5, you have to pay redemption value separately. 1 to 5 is an annuity. I don't want to write every year separate. It will be time consuming. 1 to 5 annuity, and year 5 separately will pay the redemption value. How much is the redemption value? 110. Listen, I need to discount this at 11%. Right along with me. Year 0 is 1 only. In the calculator, 1 divided by 1.11. Listen, don't follow what exactly I say. Don't do anything else. You will then spend more time. Divide by 1.11 equal to first year, equal to second year, equal to third year, equal to fourth year, equal to fifth year. Don't press GT button. Fifth year, wait, note down that number here, 0.593. Fifth year number, note down first. Don't press the GT button, okay? Now press the GT button and write the annuity factor. Now press the GT button. I'll repeat again. 1 divided by 1.11, first year, second year, third year, fourth year, fifth year. Fifth year first write the value. If you press the GT button, then you have to repeat the calculation again. 0.593. Now press the GT button. 3.696. Any doubts on this? Why we did 11%? Because we got shortcut 11%. Listen, if you earlier got 10.25, I'll not do 10.25 and all. 10%. 10, 11, 12, 13, 14. Because we will check which one will give exactly 0 in the end. We don't do 10.25 and all. If you got 10.25, try 10%. 11.25, try 11%. Many exam question, below the question, they will tell something like this. For doing the shortcut, just give me a minute. 10% and 15%. PV factor at 10% and 15%. So they'll say try 10% first, try 15% first, second. One of them may give a 0, or if it doesn't give, how to get to 0 and all, you'll understand. Exam question mostly will give 2 factors or 3, 4, 5, whatever they want to give. Here we have tried 11%. We have tried 11%. Now multiply outer column, 2 decimal outer column, 3.696 multiply and put a total. The total is called net present value. What is net present values? Total of all the present values, inflow, outflow. Net present value. What is net present values? Total of all inflow. Don't open extra columns as of now. Net present value. Are you getting exact 0? 1.1, which means 11 is wrong. 11 is wrong. Listen, as an investor, any doubts first on this? I'm doing as an investor only, keep investor in mind. We did a total, we got 1.1. Investor, when you discount at 11%, he's still having a higher inflow. Maybe 11 should increase to 12. 11 should increase to 12. There's a doubt on how we got 7. 7 is the interest we are paying. 10% into 100 into 1 minus 0.3. This is the interest we pay every year. 10% into 100 into 1 minus 0.3 interest after tax. Every year interest is paid by the company, received by the investor. Listen, we have done 11%. Investor says at 11% itself I am earning more. How more? Inflow is more than outflow. Maybe if you try 12%, total may become 0. 12% if you put a total, because see, if you do 12%, these numbers will go down, because when you discount at a higher rate, total may become 0, may not become 0 also. I don't know, it may become 0, may not become 0. Concept says I need one positive net present value, one negative net present value for me to calculate the YTM. One positive answer, one negative answer, how we get and all in some time. Okay. Any doubts first on 1.1? Any doubts on 1.1? Understood till this? Okay. Because I got a positive answer, I increase the 11 little more. If you get a negative answer, reduce it. If you get a negative answer, reduce it. Positive answer, increase it. This is investor analysis. Always do investor analysis. Okay. PVF at 12%, DCF 1 divided by 1.12 equal to first year, second year, third year, fourth year, fifth year. %. Now your notebook can't now I say do 10.5, 10.4, 10.3, somewhere in between, sorry 11.5, 11.4. Between 11 and 12 we'll get a 0 number. I need 0 total. But it's not possible for you to do like I did in Excel, saying that I'll try 11.4, 11.3, 11.2, 11.1. That and all is not possible for you to do. Till this is okay. Beyond this you can't manage in your notebook. Extra 2 columns are not needed. Reason is I have told you 8 columns because I have to get one positive answer, one negative answer. If you still got again positive, then maybe 13% we would have tried. Maybe 13% we would have tried. Anyway, I have clarity on what is the answer, so I told you to do 12%. If we could have moved to 13, we would have got more negative answer. Now I want to know at what discount rate will 90 minus and the 2 plus becomes 0 in the end. Becomes 0 in the end. Any doubts till this? Why are we focusing on the discount rate? Discount rate is called rate of interest, and that is the return earned by the investor. Earned by the investor or our cost paid by the company. Listen, if you put total of this minus 90 plus 7 plus 7 plus 7 plus 7 and 110, obviously there is extra payment. There is extra payment. That extra payment is technically interest. Interest and some principal extra value. We are paying extra to the investor. I agree to that. I told you to do shortcut. Answer came 11%. That also is okay. Now we are trying to find what rate do I follow so that 90 and 7, 7, 7, 7, 7 and 110 discounted value becomes 0. The total has to become 0. Can it become 0? Yes, 100% it can become 0. At what rate? Maybe 11.1, 11.2, 11.3, 11.35, 11.4, somewhere between 11 and 12. Because 11 gave positive answer, 12 gave negative answer. Somewhere in between, I will get a 0 answer. I want 0 answer. I want 0 answer. Unfortunately, your notebook, I can't say do the next one PVF at 11.1. Then I can't say do PVF at 11.2. Then I can't say PVF at 11.3. PVF at 11.4. So many calculation you can't do because time constraint is there. Any doubts till this first? Understood? Now I am trying to find when can the net present value. What is net present values? Outflow, inflow, total. Outflow, inflow, total becomes 0. Why will outflow, inflow, total become 0? Because we are discounting the cash flow. Moment it becomes 0, that discount rate is the rate of interest. That discount rate is the rate of interest. Yeah, tell me.
Your video is stuck.
Video stuck. Just give me a minute. Okay. So what we are trying to do here is, how can I get total as 0? If you get total as 0, it means you have discounted the cash flow at some rate. What is that rate? I tried 11, got plus 1.1. In Excel, 11 can become 11.1, 11.2, 3, 4, 5, 6, 7, 8, and somewhere I'll get 0. Notebook can't handle so many iteration, so I need some other approach to get the answer, which is where the approach is you need to get one positive net present value and one negative net present value, which we have got. We have got one positive, one negative. Any doubts till this? Any doubts in this? Okay, now come down. Below this, right? 11%. Put a timeline and write 11% plus 1.10. 11% plus 1.10. 12%, what did you get? Negative 2 point. Somewhere between this, I don't know what is that number and all. Between this, I may get exact 0. Because 11 gave 1.1. 11.1 will give maybe 0.5, then 0.4, 0.3, and ultimately will reach a 0. Now write. Difference 1%. Difference is 1%. What is difference 1%? You have increased the rate by 1%. Increase the rate by 1%. Tell me the difference between these two numbers. Sorry? It's not 1.29. 1.1 minus of minus will become plus. 1.1 minus of minus will become plus. Difference is 3.49, not percentage, sorry. 1.1 minus of minus 2.39, 3.49. Listen, I increased the discount rate by 1%. Net present value fell by 3.49. I should have smartly increased it by less than 1% so that it should have reached 0. But how I know? I don't know all that. So they say, now they are saying 1% increase, 3.49 fall. This is called interpolation technique, which is used many places at CA final. 1% increase, 3.49 rupees fall. 1% increase, 3.49 rupees fall. Question mark percentage increase, fall should be 1.1. Fall should be how much? 1.1. Why 1.1? If it falls by 1.1, you get 0. You get 0. You increase it by how much? 1%. NPV fell by how much? 3.49%. NPV is net present value. You increase it by 1%. NPV fell by 3.49. I want to increase it by maybe 0.1, 0.2, 0.3, 0.4, 0.5, some percentage, so that NPV falls by how much? 1.1. NPV falls by how much? 1.1. How do I get to that number? We'll understand. Any doubts on this first? Now below the table, right? 1% increase in discount rate equal to 3.49 fall in NPV. 3.49 fall in NPV. I'll again repeat. Originally NPV was 1.10 net present value. I wanted it to become 0. It reached, but I couldn't get 0 then. I couldn't get 0. So now I'm trying something else. So what I do here now is, this side I want the fall 1.10, right? 1.10 fall in NPV. NPV should fall by 1.10. This side, question mark increase in discount rate. Question mark increase in discount rate. Question mark increase in discount rate. I'll repeat again. 1 equal to 3.49. Question mark equal to 1.10. You'll give me a 2 decimal answer. Okay. 1 equal to 3.49. Question mark equal to 1.10. Question mark equal to 1.10. 1% increase, 3.49 rupee fall. Question mark equal to 1.1. What is this question mark? 32%. 2 decimal is fine. How you get 32? Very simple. 1.1, 3.49 into 1 cross multiplication. 1.1, 3.49 into 1 cross multiplication. 0.32% increase in discount rate will lead to 1.1 fall in NPV. I'll explain this one more time. You first write this. Fall in NPV. I'll explain this one more time. First, you have understood the calculation till now. I'm yet to come to a formula and all. I'll come to it all that as we proceed. 1% fall in discount rate. Sorry, 1% increase in discount rate. 3.49 fall in NPV. 1% increase in discount rate. 3.49 fall in NPV. Question mark increase in discount rate. 1.10 fall in NPV. That question mark is 0.32. That question mark is 0.32. Any doubts till this first? Okay. Listen, I don't want you to write anything. Listen. If you were able to visualize this, which is not possible for you, PVF at 10.32, 10.32, sorry, 11.32, sorry, 11 and extra 0.32, 11.32. If you were able to know this, how will I know? 11, I told to do 12. How will I know 11.32? It is not possible. But if at all you had known it is 11.32, you discount, you will get 0. Small rounding of differences can come. Small rounding of differences can come. Listen for some time. Let's understand this concept very clearly. And then I go forward. DCF 1. Tell me 11.32. 1 divided by 1.1132. 11.32 is 1132. First year, second year, third year, fourth year, fifth year. Fifth year values 585. Total is 3.666. if you multiply, put a total, you should get very, very close to 0 or even 0 also. If you don't get very close to 0, if you don't get 0 means some rounding of differences. Minus 90, 3.666 into 7, 25.66, 110 into 585, 64.35. Total should be 0. Total should be 0, or I think I'm getting one paise. That's okay. Listen. Let's understand this again very clearly. We are trying to find what should be the discount rate so that the total of DCF is 0. My shortcut method said 11% is the answer. So I tried 11%, got 1.1. Tried 12%, got minus 2.39. Excel means I would have told 11.2, 11.3, 11.35, 32, 31, 30, and somewhere I would have got 0. Notebook can't handle so many things. So we tried 11, got one positive answer. We tried 12, got one negative answer. Done. One positive, one negative is what I need. One positive and one negative. That last column is not for you to write, okay? Just for your understanding I've done. I got 11%, 12%. 11 gave me positive, 12 gave me negative. Between 11 and 12 is somewhere the 0 NPV. Somewhere the 0 net present value sitting somewhere in between. Somewhere in between is the 0 net present value. 0 net present value. This indirectly means every year we are paying 11.32% effectively. Every year we are paying how much? 11.32% effectively. Shortcut 11%. That is sufficient for us to solve exam question. In practical world, I want to do this. I will get 11.32. Excel has a formula to get this directly. In Excel, everything is automated. So here notebook can't handle this. Excel automatically 11.32 will come. Notebook can't handle it. So we have problem. The problem is sorted out by doing one answer, another answer, gap is there. So somewhere question can do something like this, 10 and 15, try at 10%. We will do this problem later, but 10% gave positive 3.982, 15% gave negative. Somewhere in between is the cost of debt. Somewhere in between is the cost of debt. How do we get all that? There is a formula also. There is a shortcut. There is a this one timeline approach also. First I have explained the timeline approach. Timeline approach is this. Listen, I'll explain again. 11% positive 1.1, 12% negative 2.39. Difference between 11 and 12 delta 1%. Difference between 1.19 and 2.39 delta 3.49. 1% delta 3.49 change. I don't want 3.49. I want the change to be only 1.1. I want the change to be only 1.1. How do I get exact 1.1? How do I get exact 1.1? That should have been extra 0.32, which obviously I can't exactly identify because I can't say 11. Now try 11.25, 11.26, 28, 29, 30, 31, 32. If I know the answer, I can tell try 11.32. MCQ question is there. 4 choices are there. I would have said try first choice, second choice, third choice, fourth choice. Then okay. But how will I know 11.32? So then I did 11. I did 12. I didn't get 0 in any of them. Unfortunate. Then I have to do this. Any doubts first on this? Any doubts till this first? Can we proceed? Any doubts in this? Now, this 11.32 ICAI also has a formula to get to this 11.32 using this calculation only. Any doubts first on this? Any doubts on this? Can we proceed? Understood? Now right. You got this 11.32 first. Below the table, right? YTM KD 11 extra 0.32. 11.32. And extra 0.32, 11.32. Any doubts till this? Okay, let's understand how did this 0.32 come and which will what ICAI has made as formula. Listen for some time. 11. This 0.32 was 1.10, 3.49 into 1. 1.10 by 3.49 into what? 1. This is how you got that 11.32. Wait. I don't want to write anything. This 11 is called L1. L1 means lower rate. L1, there's a formula which ICAI has given. L1 is called lower rate. Do I need to remember the formula? Not mandatory. If you can do directly the timeline approach. You don't want to think so much, then remember the formula and do it, okay? L1 is the lower rate. 1.10 is called NPV at lower rate. NPV at the lower rate. 1 is called L2 minus L1. L2 minus L1. What is L2? Higher rate. L1 lower rate. L2 minus L1. ICAI gave the formula. First I have done the calculation. Now I am giving you the formula. L2 minus L1. 3.49. 3.49 is NPV at L1 minus NPV at L2. Minus of minus will become plus in the calculation. Okay. NPV at L1 minus what? NPV at L2. This is the formula given by ICAI. But we have first done the application. Now I am giving you the formula. First we have done the application. Now I am giving you the formula. Wait for some time. I'll give you time to write. There are certain concepts which I wanted very, very clear. So I'm spending a lot of time. Initial part, I don't want any issues there. Okay. So L1 means lower discount rate. What is the lower discount rate in our calculation? We had two rates. 11. How much was the NPV at L1? 1.10. What is the NPV at L2? Minus of minus will become plus in the calculation into 12 minus 11. Ignore percentages for the time being. This is 11. This is 1.1. 3.49 into 1, and in the end you get 11 plus 0.32, 11.32, 11.32, 11.32. Able to understand this? I'll give the formula. Just give me some time. So point is, one approach is to do timeline. What is timeline? 11%, 12%, 11%, 1.1. 12% minus 2.39, somewhere in between you have a zero NPV. Somewhere in between, what is that number? I don't know. Somewhere in between we have a zero NPV. This logic is called interpolation. For example, 2020 India's population is 140 CR. 2010 India's population is 120 CR. In between, in 10 years, population increased by 20 CR, which means every year population would have increased by 2 CR is the logic. Every year population would have increased by 2 years. So you have 2010 population, you have 2020 population, you want 2011, you can calculate. 2012, you can calculate. 2013, you can calculate. 2014, what will you calculate? Every year 2 crore increase. Every year 2 crore increase. This is called interpolation. This is called interpolation. Is a person's height when he's 6 years 90 centimeter, 9 years his height is 100 centimeter, in 3 years height increased by 40 centimeter, every year increases 13 centimeter. So you want 7th year height, 8th year height, 9th year height, you can do interpolation. You can do interpolation and calculate it. This is the logic which interpolation says. You have two numbers, you want any number in between, you can calculate. Any number in between you can calculate. Logic is very simple. I know that, for example, at 2 o'clock the temperature is 40 degrees, at 5 o'clock the temperature is 50 degrees, and there's a uniform increase is the assumption. Assumption is always uniform increase. 2 o'clock 40 degrees, 5 o'clock 50 degrees. In 3 hours temperature increase by 10%. Every hour temperature will increase by 3.33% or 3.33 degrees. Every hour it will increase by 3.33 degrees. This technique is called interpolation. It can be used for finding any in between number or even outer number also. What is outer number? Till 2020, you know, 2021 also increase would have been 2 CR. Increase would have been 2 CR in the population. 22 again 2 CR. Will it uniformly happen? No. But this is the assumption. This is how it works. It assumes that there will be a uniform increase or uniform decrease. Uniform increase or uniform decrease. When 1% it went up, NPV decreased by so much. I don't want it to decrease by so much. I want it to decrease only by 1.1. Only 1.1. Any doubts till this first? Now you write this. Now write. YTM, write along with me. Bracket cost of debt equal to 11 plus 0.32. 11.32%. 11 plus 0.32. I'll give you the formula after this is done in the same calculation. Okay. 11.32. Then write again 11. How we got 0.32 was 1.1. 3 point, how much it was? 249 into 1. Into 1. Clear? Then again 11 into 1.1. Let's understand how we got 3.19. 1.1 minus of minus. Minus of minus 3 point, sorry, 2 point, just 2.39. Don't remember the formula. I'm not touched the formula till now. Okay, 2.39. How we got 1 is minus 11. 12 minus 11. Clear? Able to understand this? And now ultimately I'll say this is called L1. This is called PV at any timeline approach. Directly write the formula in exam. Very clear. If you can remember the formula, directly write the formula. You don't remember the formula, then try the timeline approach. NPV at L1 minus NPV at L2 L1. Okay, this is the formula. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. Do we need to remember the formula? Ideally, no. If you can do the timeline approach. Somebody doesn't want to do timeline approach, then better to remember the formula. Clear? This is what will be the YTM or IRR. Objective is to get a zero total at some discount rate. At some discount rate. If I can exactly predict that rate, this formula is not needed. You can exactly predict that rate, formula is not needed. Directly if somebody can find 11.32, which is impossible for you to do, I can do it in Excel. If you can exactly predict 11.32, no formula needed, nothing. I had shown you earlier one calculation by doing 0.2122, 23, 24, 25. If you can exactly predict, story over. If you cannot exactly predict, then you need this formula. One positive NPV and one negative NPV. Any doubts in this? I'll do problems on this in the next session. There is some problem with my laptop today, so I'll try to sort it out and then do in the next session. Any doubts on this? Any doubts on the concept? Under the approximation method, interest after tax plus average other cost by average funds employed. And the other method, when you want to follow, you will have to do the IRR approach. IRR approach is very simple. Do one discount rate, get zero NPV. Not getting it, increase the discount rate, reduce the discount. Positive, increase it. Negative, reduce it. Positive, increase, negative, reduce it. Positive, increase, negative, reduce it. Once you get one positive, one negative, apply the formula. Any doubts on this? Clear? I'll end the session with this today. Next to concept, and then I do a question. Now listen. Valuation of bond. Listen for some time, and then I show it with the concept book. Valuation of bond. Now let's first understand value of any asset. Value of any asset. You want to value any asset in the practical world. I want to value this building. I want to value this laptop. I want to value a calculator. I want to value a water bottle. I want to value any asset. Asset, I mean here, this approach is which generates income. Okay. So for example, if you want to value a car which you are using for personal purpose, this logic will not work. You want to value a car and you're using it for commercial purpose, that is
you are letting it out on rent, or you are using it as a Ola service or an Uber service, maybe you can value the asset using this logic. Logic is very simple. Present value means today's value of future cash flows. Future cash flow. We don't work with profits. Future cash flow. What is future cash flow? This building first year will give me rent of 1 lakh rupee. No expenses assumed. Only rent is there. No expenses, no tax, nothing is there. So first year I get 1 lakh. Second year I get 2 lakh. Third year I get 1 lakh 50. Fourth year I get 3 lakh. Fifth year I get 3 lakh 50. Sixth year I get 7 lakh. At the end of sixth year, building is sold for 1 year. Building is sold for 1 year. Put a total of all of this, not a normal total. Discount it and put a total. Discount it and put a total. You can't add them together as of now, because as I said, time value of money is very, very critical. I keep going back to time value of money concept. There we learn first year, second year, third year, fourth year, fifth year, sixth year can't be added. So I want to value any asset, present value of future cash flow. Now what is this? Value of building. I want to value a building. Present value of rent plus sale value. Rent and sale value, provided there are no expenses and other things. Okay, if there are expenses, obviously expenses will be reduced from the income, and net amount, taxation, everything you have to reduce. Assuming none of them is there, just to do present value of rent plus sale value. I want to value of car, present value of net income from Ola plus resale value at end of life. Net income is whatever income comes, some expenses are there, petrol expenses, diesel expenses, insurance expenses, driver expenses. After all of that, whatever value you get, that is the net income from your Ola services plus the resale value at the end of life. Any asset you take, there is always a regular set of income will come, and at some point of time you will sell off that asset. Now what is the use of this? Value of bond. Bond equal to present value of interest income. Present value of interest income plus principal at end of life. Principal at end of life. Present value. Present value means you will have to discount it at some rate. Without discounting you can't do it. What discount rate and all we'll understand. But present value of interest income, first year interest, second year interest, third year interest, fourth year interest. Principal, I said end of life, there are certain bonds which pay principal every year also. Or you just let us call it as present value. The present principal can be paid on the last day, or I may say I'll pay 1/5, 1/5, 1/5, 1/5 every year. That's my wish. Depends on the terms of the agreement. This is present value of interest income plus principal. You will have to discount it. Present value means discounting has to be done. What rate we discount and all we'll discuss. Okay. So value of redeemable bond. Why redeemable? Redeemable only will pay principal. What should I do for irredeemable bond then? Value of irredeemable bond. Is irredeemable bond a perpetuity? Is irredeemable bond a perpetuity? Participate. Is irredeemable bond a perpetuity? What formula you learn for present value of perpetuity? Perpetuity amount divided by rate of interest minus growth rate. We may not have growth rate concept here. Rate of interest, or the other practical name for this is called discount rate. It is technically called discount rate. So perpetuity amount I will divide by something called as a discount rate and growth rate. Now, okay, all this is understood. What should be the discount rate? Should the discount rate be the interest which the bond is paying? Not necessary, because bond was issued 10 years ago. That time you were paying 10%. Now inflation would have gone up. So your expectation from the bond would have changed. The inflation would have gone up, gone down. Anything can happen in the practical world. See, when I value a bond, I need a discount rate. Anything you calculate. For example, I want to value the building. You need a discount rate to value the building. If you use a very high discount rate, the value will get depressed. If you use a very low discount rate, the value will become very high. This is how the rule is. discount rate has an impact on the valuation. Do you want to use a lower discount rate or a higher discount rate? Depends on certain parameters. What are those parameters and all, you'll understand. But I need a discount rate. More on discount rate only at CA final you'll understand. Valuation is not very critical for us. One some 2-3 questions are there. Concept is very simple. I have got the rental income. I have got the sale value. I told you to do the estimation. We sat across, did some analysis, got the rental income, got the expenses, property tax, maintenance, all put together. Final net amount we have got. Sale value also we have got. In the net income, income tax may come. In the sale value also income tax may come because there's a capital gain, all that can happen. I've done all the analysis. Now I need one discount rate. Simple logic of discount rate in the practical world is inflation plus real return on risk-free investment. Real return on risk-free investment, or to put together, this is risk-free rate. Put together, this is called risk-free rate. What is put together risk-free rate? Inflation 5%, real return 2%, 5 plus 2, 7 is what government is giving. 5 plus 2, 7 is what government is giving. Plus risk premium. What is risk premium? If you feel this building is a risky investment, extra you may add 5-6%. If you feel it is not a risky investment, you may add extra 1-2%. As you increase the risk premium, discount rate goes up, value goes down, which is logical. If it's a risky investment, I want to pay lower price. I want to pay lower price. If it is not a risky investment, I want to pay a higher price. Practical world, this is how discount rate will be decided. You are giving a loan to your friend. Maybe you will charge 5 plus 2, maybe plus 0 also. Thinking that, okay, friend only, I don't want to charge. I'm not worried about the return of the money. So risk premium for you could be 0%. I give the loan to the same person you are giving. He is not related to me. I may charge 5 plus 2. That is standard. 5 plus 2 is standard. Extra I may charge 4%. Extra I may charge 4%. SBI FD. SBI FD 5 plus 2 plus 0. I don't know anything. SBI is like risk free. Equitas FD. Equitas is also one bank, but that is not as strong as SBI. So you will charge 5 plus 2, maybe extra 1%. They give higher interest rate. They give higher interest rate. Unknown company. Company itself is not known. You will see some ads saying that interest rate is 12%, 13%, 14%. SBI is giving 7%. Some other guy is giving 14%. Both are same only. No, it is FD only. You are giving 1 lakh. One person is paying you 7%. One person is paying you 14%. Reason is very simple. That 14% guy may not return your money also. May not return your money also. The 7% guy, SBI, will not default. SBI will not default. So SBI, when is there, I am okay with 5 plus 2 plus 0. When it is an unknown random company, I want 5 plus 2 plus 10 also, or 5 plus 2 plus 5 also. This, the calculation is not critical. They'll give you the discount rate, but this is for your understanding. 5 plus 2 plus, if I feel this building is risky, I may do 5 plus 2 plus 3. You feel it is not that risky, you may do 5 plus 2 plus 1 also. The discount rate can change. When discount rate changes, the valuation for me is different, the valuation for you is different, and that is where a buy and sell will happen. See, I feel this building is worth 2 CR. You feel the building is worth 2.5 CR. And I want to sell it for, because I feel it is 2 CR, you feel it is 2.5 CR, I want to sell it for 2 crore 20 lakh. I am happy because I feel it is 2 crore worth. You are also happy because you feel it is 2.5 crore worth, you are buying it. If both of us think like exactly same, no transaction will happen in the practical world. I also feel 2 CR, you also feel it is 2 CR, I want to sell it for 2.2 CR, you will not buy it. You will not buy the building if I feel it is 2 crore worth, you also feel it is 2 crore worth. How will a sale transaction happen? In the practical world, a buy and sell happens in many assets only because people have different expectation on the value. People, I'm selling a car. Let us just take an example of car where you don't value like this and all. I have a car. I feel it is worth only 80,000. I'm trying to sell it for 1,20,000. You somehow feel this car is worth 1,50,000. And when I said 1,20,000, you got excited and ready to buy it. You got excited and ready to buy it. So people will buy when the value of that asset is lower than the value they perceive it to be. They perceive value 150, market is giving 1 lakh or 1,10,000, you want to buy it. People will sell it when they perceive the value in the market is higher and you feel the values on the lower side. Then only a sale transaction will happen. No buying transaction, no selling transaction can happen if everybody thinks alike in the practical world. If everyone thinks same way, stock market, lot of buying selling happens. If everyone thinks share price will go up, why will somebody sell it? If everyone thinks that share price is going to go up, then everyone would want to buy it. Nobody wants to sell it. How will a transaction happen? So every transaction in the practical world can happen only if people have different expectation. That different expectation will come from valuation. So how will you value of any asset? This is a very important rule. Okay, this can, in the recent AFM exam, this got tested again. This concept got tested on valuation, but there also you learn it at final level. Value of any asset you want to value, present value of future cash flow. Present value of future cash flow. The cash flow can come from interest income plus a principal. I want to value preference share, preference dividend plus redemption value. I want to value an equity share, equity dividend plus at some stage maybe a buyback happen, and if no buyback is happening, irredeemable. Then look at the irredeemable valuation. Look at the irredeemable valuation. How will you do irredeemable valuation? Same perpetuity amount logic. Any doubts first on the concept? Okay, now I'll show it in the concept book. Listen, valuation of bond, irredeemable debt, valued like a perpetuity, valued like a perpetuity. What is value like a perpetuity? Interest in rupees divided by investor yield or market yield. What is investor yield? Technically they'll give you directly, but what is investor yield is R, the risk-free rate, that is inflation plus real return plus the risk premium. Inflation plus what? Real return plus the risk premium. Redeemable debt, two options are available. Problem silent, you will have to do this only. Detailed approach. What is detailed approach? Present value of future cash flow discounted at investor required rate of return. Come to this place and write to be followed if silent. If silent. When it is cost of redeemable debt, shortcut is followed if silent. Okay, shortcut is followed if silent there. Shortcut is followed if problem is silent. What is shortcut? Same formula you do. Interest in rupees divided by investor yield or market yield. Interest in rupees divided by investor yield or market yield. Any doubts till this first? Interest in rupees divided by investor yield or market yield. Whatever I'm explaining here will keep coming back at CA final. So it is not anything. Whatever I'm saying again got tested in exam. The points are, questions are continuously coming from CA Inter also there. Okay, interest in rupees divided by what? Investor yield or market yield. This formula is nothing but present value of perpetuity. What is the present value of perpetuity? Perpetuity amount divided by discount rate minus growth rate. There's no growth rate concept and all. They will not increase the interest payment and all. So divided by discount rate. What is discount rate? Investor yield or market yield. Any doubts till this first? Clear? Can we proceed? Okay. Now in the context of this, another thing we are going to understand is okay. Let's assume coupon rate. Coupon rate is the interest rate. 10% on 100. Okay. Again 10% on 100. 10% on 100. Discount rate. Discount rate is investor yield It's called investor yield or market yield. Investor yield or market yield. 8%, 10%, 12%. Three numbers are the 8, 10 and 12. Valuation. Valuation is perpetuity amount. Perpetuity amount is interest in rupees divided by the discount rate. So when I do valuation, this is irredeemable. Okay, I'm discussing irredeemable. Valuation is 10% into 100 divided by 8%. 10% into 100 divided by 8%. What is 8%? Discount rate, investor yield, market yield, investor required return, investor expected return. Different names you can use. What's the value you get? 125. Second scenario, divided by 10%. We get 100. No need to write anything, just be in listen mode, understand. Third scenario, divide by 12%. 83.33. Now, company is little confused. They are saying it is the same bond, but market will give different value in different situation. Market will give different value in different situation. Also, this can change. This can change every 3 months, every 6 months, every 9 months, every 12 months. How it can change? RBI increases interest rate, or inflation goes up, the discount rate will go up. Inflation goes up, discount rate will go up. Inflation goes down, discount rate will go down. Risk of a company goes up. See, that company I invested, and Anil Ambani companies 10 years back may not be risky. Now they're very, very risky. So risk goes up, risk premium will go up. Risk goes down, risk premium will go down. Anything can change in the practical world. What can change? Inflation can change, or risk premium can change. So accordingly, the value can keep changing. Now, why did I discuss this? What is the coupon rate the bond is paying here? 10%. What is the investor wanting? 8%. If I pay more than what investor wants, if I pay more than what investor wants, he will give me a premium valuation. He will give me a premium valuation. I exceed your expectation. You wanted how much? 8%. I exceed your expectation. You exceed my expectation by giving 125. I exceed your expectation. You exceed my expectation. What did I exceed? I gave you fantastic classes. You have started giving me a fees higher than the normal average fees of the industry. When I give fantastic classes, people are ready to pay a premium pricing fees which is higher than the average fees of the industry because of the fantastic classes. Second scenario, I give you 10, you also want 10, I meet your expectation, you meet my expectation of par value. You meet my expectation of par value. Third scenario, I pay 10%. You are cribbing saying that you wanted 12%. You are saying you wanted 12%. I can't change my interest. Then you depress the valuation and give a discounted value. Give a discounted value. Deep discount bond. I don't pay anything. 0% payment. Value is significantly depressed to 2,500 on 1 lakh in that example. 2,500 on 1 lakh. I exceed your expectation. You exceed my expectation. I meet your expectation. You meet my expectation. I am not able to meet your expectation. You are also not able to meet my expectation. You are also not able. Listen, the discount rate which you see here can change if inflation changes. Can change if inflation changes. Can inflation change in the practical world? 100% yes. Real return is a balancing factor. That's okay. Risk premium can change if risk goes up. Risk premium can go down if risk goes down. And obviously, the risk can also change in the company. Today, if you take another bank, Yes Bank, 10 years back, Yes Bank and all was a very strong bank. Then suddenly, I think 2 or 3 years back, it went into lot of trouble and RBI had to intervene and all. So now S Bank interest rates and all will be very high. If you look at FD rates of S Bank, they will be on the higher side. Maybe some 10 years back, they were paying normal FD rates. They were not having a high risk premium. But now people feel it is very risky. People feel it is on the riskier side. Able to first understand the concept till this? Okay. Now this is presented here. Likely issue price of a bond. Likely issue price or current market price. Issue price if you are issuing today. CMP if issue has already happened. Interest rate equal to investor expectation. What is investor expectation? Discount rate. Equal par value meets expectation. I pay more premium value. I pay less discount value. I pay less discount value does not meet expectation. This can may get tested as an MCQ question. Not as an MCQ they test also, but it's good concept to be aware of. Any doubts on this? Value of a bond. This chart was for the irredeemable one. Redeemable also same logic will work, but calculation will be little lengthier. When I say lengthier means you'll have to do year cash flow, PVF, DCF. Year cash flow, present value factor, discounted cash flow for us to do any kind of valuation. Any doubts on the concept here? Any doubts on the concept? Can we proceed? Clear? Valuation, simple logic. Anything you want to value. I want to value this pen. If I can write cash flow from the pen, this pen, if it gives me some cash flow, year 1 cash flow, year 2 cash flow, year 3 cash flow, at the end of 3rd year, the pen is sold for some value. Pen is sold for some value. If at all I can bring that, do year cash flow, PVF, DCF. Year cash flow, PVF, DCF. I want to value one company, right? Tata Consultancy Services. Year cash flow, PVF, DCF. First year, what is the cash flow of TCS? Second year, cash flow of TCS. Third year, cash flow. Cash flow could be your operating cash flow or whatever be the scenario. All that you'll understand later. 1, 2, 3, 4, 5, 6, 7, 8, 9. And at the end of 10th year, I sell the TCS for some value. Some value you do and do a discounting. Do a discounting. Anything can be valued using this logic. And this is called DCF, discounted cash flow approach. Discounted cash flow approach. Very, very common method of valuation. Very common method of valuation is DCF valuation. Obviously, certain things can't be valued under DCF method. I can't value the calculator using a DCF method, or I can't value my laptop using a DCF method, or I can't value my car using a DCF method if I'm using car for personal purpose. If I'm using it for personal purpose, I can't value it. Then we need some other ways and all. All that you'll understand later. Any doubts on this? Understood? Okay. Till now we have learned something called as redeemable, irredeemable. Let's now understand convertible. Convertible bonds. Any idea what is convertible bonds? Bonds which will be converted or can be converted. It could be optionally convertible. It can be compulsorily convertible. Formula for cost of convertible debt is same as redeemable debt. What is the formula? Interest after tax. Okay, irredeemable can't be redeemable. Interest after tax plus average other cost by average funds employed, or IRR method, or IRR method. Formula same, everything same, only one difference. Redeemable value in that formula will be higher of something. What is higher of and all? I'll explain. Redeemable value in that formula. In that formula, what is the formula? Interest after tax plus RV minus net proceeds by balance life divided by RV plus net proceeds by 2. Or year 0, you write some outflow number, 1 to 5 some inflow number, year 5 some redeemable value number, you used to discount and then get the answer. That redeemable value is higher of the 2 number. What is higher of the 2 number? Redeem as debt. Redeem as debt can be at par, premium, discount. Silent means we take par value and then close it. There is a bond with 100 rupees face value. Redeemable value will be 100. Or other option is convert into equity. I can redeem it as debt. I can also convert it into equity. What is convert into equity? After 5 years, see, you want to get something out of the debenture. You can get two things. I will pay rupees 150. Okay, this is the redeemable value. Or give two shares whose value on that day value I need, whose value on that day, how you get and all we'll see, whose value on that day is rupees 100 per share, whose value on that day means after 3 years, after 5 years, after 10 years, after 15 years, how we get value and all we'll see later. But I want the value after how many years? After so many years, what is the value of the share? What is the value of the share after how many years? After so many years, how much? 100 per share. Now I give choice to you. What you will do, you'll think in your mind. If I give you money, it is 150. If I give you share, 2 into 100, 200, get share, immediately sell it. Get share and immediately sell it. You don't want that company, immediately sell it. By doing that, you will get 200 rupees. Otherwise, you'll get only 150 rupees. Otherwise, you'll get only 150 rupees. I give the choice to you. It's optionally means the choice is there. Compulsorily means no choice. Convert into equity will only happen. So, either I pay you 150 or I give you 2 equity share whose value is 2 into 100. You will obviously say my redeemable value is convert into equity rupees 200. Convert into equity rupees 200. Convert into equity rupees 200. This may happen, may not happen also. On the last day, instead of 100, it is 40 per share. It is 40 per share. 2 into 40 is 80. You tell the company, don't give me share at all. Return my 150. Return my 150. That is why it's higher of the two. Higher of the two means what? Either you can convert into equity or you can redeem it as debt. Redeem debt, okay. Convert into equity means I need the value of equity share after 5 years, 3 years, 10 years. How and all, valuation and all, you will learn as we proceed. As of now, we may not discuss much on equity valuation because we'll have a separate chapter on that. But the concept is simple. We are trying to find which is better for us. This is if it's optionally convertible. Compulsorily convertible means first choice is removed. Compulsorily convertible means 2 into 40 only, that's all. You don't say 2 into 40 or 150, whichever is higher. That story is not there. 2 into 40 or 150, whichever is higher, story is not there. It is only 2 into 40. It is only 2 into 40. Now, let us see this here. Cost of convertible debt, same formula as redeemable debt. Approximation method, only difference in redeemable value. IRR method, only difference in redeemable value. What is redeemable value? Take at par or convert into equity. What is convert into equity? Expected share price on maturity. Expected share price on maturity. Maturity means after 5 years, not today's price. Don't tell me today's price and do the calculation. Expected. How will you do? All that we'll see later. Into number of share. 1 bond, 2 shares. 1 bond, 3 shares. 1 bond, 5 shares. I may give anything, okay? But I need to do that calculation. Whichever is higher, calculate it, use it in the formula. Calculate it and then use it in the formula. Which formula? Approximation method or IRR method. Approximation method or IRR method. Able to understand the difference? Convertible debenture has a choice given to you. Choice, optionally convertible means choice given to you. If you want, I'll pay you 120 rupees or I'll give you 2 equity share of 70 rupees each. You happily say give 2 into 70. 2 into 70. For the company, that free debentures which are given is like outflow of money. It is like outflow of money. Why is it outflow of money? Because if I had issued that debentures to someone else, he would have paid me shares to someone else. He would have paid me 140 rupees. You are taking it free of cost. You are taking it free of cost. I remove one liability and create another liability For removing the liability, best way is to pay money. If I pay money, you say it's outflow of money. If I don't pay money, I buy this building. I can buy the building by paying cash or by giving another building to him, or shares to him, or debentures to him. Consideration can be in cash, can be in other than cash. Able to understand the concept? The only difference is in redeemable value, or only difference is in maturity value. The better word is maturity value, but I don't want to change the formula. The only difference is in redeemable value. What is redeemable value? Higher of 2. What is higher? Redeemitors debt are convert into equity. Redeemitors debt are convert into equity. Redeemitors debt are convert into equity. The redeemitors debt is fixed. It is 110, 120, 130, whatever number. It's already decided. Convert into equity can keep changing. If company suddenly starts doing really well, my expectation of the share price after 5 years will be very high. Starts doing bad, my expectation of the share price will go down, and maybe I'll redeem it as debt. First year when I do valuation, my analysis may say redeem as debt. Second year when I am doing the cost of debt calculation, maybe my analysis will say convert into equity. Redeem as debt, convert to equity, redeem. It can keep changing. But the point is very simple. When you do your cost of debt calculation, redeemable value has to undergo a change. Redeemable value has to undergo a change. Clear? Able to understand this? Any doubts on this? Can we proceed? Let's come to this now. TT Limited issued 10% convertible debenture of 100 each with a maturity period of 5 years. At maturity, debenture holder will have the option to convert debenture into equity shares in the ratio of 1:5. Option means I'm not forcing it to you. Current market price of equity. Current means today's price. I don't need today's price. I need future price. Current market price is 20 each. Historically, the growth rate of the share is 4% per annum. Assuming tax rate is 25%. Compute the cost of 10% convertible debenture using approximation method and IRR method. Let us first do the approximation method. For IRR, the two rates I'm going to use is 10 and 15. The two rates we are going to use is 10% and 15%. Able to understand this? Can we start? Working note 1. Cost of convertible debt using approximation method. Using approximation method. Cost of convertible debt. I'll copy the formula. You know the formula, write the same formula. Your redeemable debt formula. Cost of convertible debt interest into face value into 1 minus tax rate, RV minus NP by balance life, RV plus NP by 2. Can we leave some 5-6 lines? Note 1, computation of redeemable value. Redeemable value. Better word is maturity value, but I don't want to change the formula, so I'm using the word redeemable value. Redeemable value is higher of the following. is higher of the following. Higher of the following. See, on the last day, I have been given a choice. I have been given a choice to either redeem it as debt or convert into equity. First is redeem as debt. What is the face value of the bond? 100. Any redemption value given, par, premium, discount. Any redemption value given. Option to convert is okay. Any redemption value given. Rupees 100. Assumed as par. Assumed at par. Redeem as debt. Redeem as debt. Rupees 100. Assumed at par. Par valuation. Convert into equity. Convert into equity. Convert into equity. That's the second choice given to me. When I convert into equity, one debenture will become how many shares? 5 equity shares into share price on or share price after 5 years. Not today's price. I want the share price after 5 years. Share price after 5 years. Why 5 equity share? Option is to convert 1:5. 5 shares for each debenture. 5 shares for each debenture. Rarely it can be half a share for each debenture also. Half a share means if you have 2 debenture, you will get 1 share. Half a share also possible. Here it is 1:5. 5 shares for each debenture. 5 shares for each debenture equal to 5 into 5 into 5 into what is the share price today? 20. Listen, this 20 historically is growing at the rate of 4% per annum. Historically it is growing. So listen, my expectation is this 20 will grow at 4% for the first year. Grow at 4% means into 1.04. Again grow at 4%. Historical growth I have taken. This will happen 5 times. This will happen 5 times. Listen, I'll repeat again. 5 into 20 is today's price. After 1 year you want the price into 1.04. After 2 years you want the price into another 1.04. After 3 years you want the price into another 1.04. After 4 years into another 1.04. Growth of 4%. Growth of 4% means you can do in the calculator itself 20 plus 4%. No need to do into 1.04 plus 4%. First year growth plus 4% second year growth plus 4% third year growth plus 4% fourth year growth plus 4% fifth year growth. This number is nothing but into 1.04 power 5. Into 1.04 power 5. 20 plus what? 4% plus 4% plus 4% plus 4% plus 4% plus 4%. How many times? 5 times. Or you can do into 1.04 power 5. Will I get the same number? Yes, you will get the same number. Whether you do into 1.04 power 5 or add what? 4. Any doubts on this? But you can't add directly 20%. Okay, don't say 4 into 5 and I'll add 20. That will not work. I'll repeat again what we have done. 20 into 1.04 into 1.04 into 1.04 into 1.04 into 1.04 or 20 plus 4% plus 4% plus 4% plus 4% plus 4%. We get 24.33. We get 24.33. So on the last day, 5 into 24.33. 5 into 24.33. 121 point. I'll explain again this. Now 24.33, if you round off and do the multiplication, it is 165. If you don't round off and then do into 5, you'll get 67. I have run rounding off 121.65. If you leave the number as it is in the calculator and do into 5, you will get a different answer. That is no rounding off then. Clear? 121.65. 67 is also okay. 67 means you are not rounding off anything and directly doing the final number. Any doubts on this? Now in the above formula, everything else is same. Apply 1 to 1.65. Apply 1 to 1.65. Apply what? Redeemable values are 121.65. Wait. If, listen. Today it was 20 rupees. In a single day itself, share price has gone down to 15 rupees. Now what I will do? 5 into 15 into 1.04 power 5. Maybe 100 looks better and this doesn't look better. I don't know. We have to do the comparison because share price can keep changing every day. After 1 year you want to do the same analysis. Listen. After 1 year you want to do the same analysis. That time share price is 15 rupees into 1.04 power 4. Only 4 more years. Only 4 more years. That may be greater than 100, maybe less than 100 also. Greater than 100 or less than 100. Anything can happen. Able to understand this? Any doubts on the concept? Any doubts on the concept? Clear? Can we proceed? Go up and do the formula. You keep doing it. Refer the screen if you wish to. But I don't see any major confusion now. Do it, confirm the calculation. It is only changes on the redeemable value. There's only one change which is on redeemable value. We'll have to take the redeemable value as higher of the two numbers. Redeemable value as higher of the two numbers. Any doubts in this? Can we proceed? Clear? Any doubts? Can we? Done? Working note 2. Anybody has any doubts on this? I'll repeat again. Redeemable value, which is the last day value, you have to take higher of the two numbers. What are the two numbers? Redeemer's debt convert to equity. Redeemer's debt convert to equity. Redeemer's debt convert to equity. Any doubts on this? Next, cost of convertible debt using IRR method. Using IRR method. Answer will be very close to 10.67. They have given two numbers, 10 and 15. We'll use those two and do the calculation. Cost of convertible debt using IRR method. Using IRR method. I will need only 6 columns here. I don't see a 8 column requirement. 6 column. At 10% we will do, at 15% we will do. And objective is to get 0 NPV, which will not come. In the formula, answer will come. Why 10 and 15? Below the table. Below the table, they have given PV factor at 10%, PV factor at 15%. Answer somewhere is going to be between 10 and 15. Somewhere between 10 and 15. Year cash flow PVF DCF. Year cash flow PVF DCF. PVF at 10, PVF at 15. PVF at 10, PVF at 15. Somewhere 10 or 15 will give us the answer. 10 or 15 will give us the answer. Mostly it will be very close to 10.61, could be around 11 type, using IRR method. Can we start? Year 0. How much will the investor pay today? Year 0 minus 100. Minus 100. Year 0 minus 100. The clear focus is on cash flow. Once that is clear, balance is just a formality. 1 to 5 years. 1 to 5 years, you will pay interest after tax. Interest after tax. You will receive, company will pay. Interest after tax. 100. Okay, we already know the number. 7.5. Where is that 7.5? Interest after tax. First year, second year, third year, fourth year, and fifth year. Fifth year separately. Fifth year separately, you will get the redeemable value, which we have already done the calculation. Fifth year, we will get the redeemable value. Redeemable value is 5 equity shares. 5 equity shares. That is what our calculation said. Fifth year, it will be 1 to 1.65. 121.65. One to 1.65. Any doubts on this? Okay, now listen. PVF at 10%, don't do calculation and all. Copy the number given in the question. When I say copy, add those 5 numbers which are given. PVF at 10%, add the 5 numbers. PVF at 15%, add the 5 numbers given in the question. Please add the numbers. There can be a slight rounding of difference if you add and if you do your on your own. 909, 826, 751, 683, 621. You confirm that 5 PVF I'm adding, okay? Annuity factor is adding those 5. Can I do it at the calculator? Yes, you can do like the way we do. It may have a slight variation. If we do, we'll get 3.791. I'm following whatever they have given. You can do it. Let me know if at all you have a doubt. Somebody confirm, are you getting these numbers? I was trying to get a zero number, which I couldn't get. I've got something else here. $14.39. $14.39. Can we proceed? Let us apply the formula. Any doubts first on this calculation? Any doubts on the computation here? Anybody has any doubts on the computation? Can we proceed? Clear? Any doubts on the calculation? Write the formula. Cost of debt L1 plus NPV at L1 by NPV at L1 minus NPV at L2 into L2 minus L1. Logic is explained with that timeline approach. Presentation wise, formula looks better. L1 NPV at L1 by NPV at L1 minus NPV at L2 into L2 minus L1. Cost of convertible debt. L1 plus NPV at L1 by NPV at L1 minus NPV at L2 into L2 minus L1. Again, you do it. I'm not even trying to explain this part because done two examples earlier. You do it and then refer the screen. $18.365 plus how much? 0. We earlier got 10.67. Now we have got 11.08. Now coming to cost of equity. Does equity have a limited life? Is there a limited life for equity? Participate. No, sell and I'll leave it. Let's assume I am having shares of Bharadwaj Institute. Is there a life associated with this share? There is a perpetual life. There is no end. I may give it to someone else. He may give it to someone else. He may. That's a different story. But it is a perpetual debt. It is a perpetual instrument, not debt. Perpetual instrument. There is no end to an equity share unless company goes ahead and does buyback and all. But otherwise, there is no end. If there is no end, our cost is equal to, listen, we are going to use this formula. What is this formula? How does this help and all? You'll understand. Present value of perpetuity equal to perpetuity amount of first year divided by rate of interest minus growth rate. I'm going to alter this formula and then get to the cost of equity. And this formula will work if company is paying dividend. There are companies who don't pay dividend. What will happen? We'll understand as we proceed. Okay. Present value of perpetuity, perpetuity amount of first year divided by rate of interest minus growth rate. Then present value means today's value. So today's value of equity share is called P0. P0 means current market price. P means price. Price of an year, 0. Perpetuity amount of first year means dividend of first year, next year dividend. Dividend of first year, otherwise called as D1. Dividend of first year is called D1. D1. Can dividend change every year? Can equity dividend change every year? Yes. Interest doesn't change. Equity dividend can change. So I need to take the first year dividend. First year means next year dividend. Divided by rate of interest is called cost of equity. Rate of interest is called cost of equity. Growth rate can be there. There can be a growth rate in the dividend. There can be a growth rate in the dividend. I interchange the formula. I get cost of equity minus growth rate. This comes this side is equal to D1 divided by P naught. D1 divided by P naught. D1 divided by P naught. Same formula. Present value of perpetuity equal to perpetuity amount of first year divided by rate of interest minus growth rate. Rate of interest is cost of equity. Growth rate is growth rate only. And dividend of first year, otherwise called as D1. Dividend of first year, otherwise called as what? D1. Okay. Then I proceed forward and say KE equal to D1 divided by P naught plus G. G is the growth rate. This is the formula for cost of equity. This is the formula for cost of equity. The formula comes from perpetuity because there's no end. There's no end. Growing per. Some question growth will not be there at 0. Growth is not there at 0. No problem. So the formula is D1 by P naught plus G. D1 by P naught plus G. Now this is a formula to calculate cost of equity. Also the formula to value the share. If you want to value the share, dividend of first year divided by KE minus G. You want to value the share, dividend of first year divided by cost of equity minus growth rate. Cost of equity minus growth rate. Any doubts till this? Any doubts on this? Understood till this? Okay. In this, sometime there can be a flotation cost. So if you have flotation cost, please subtract it here. If you have flotation cost, please subtract in the calculation. From a company point of view, D1 by P naught minus FC is very simple. D1 by net proceeds. It's like net proceeds. It is net proceeds. Net proceeds. Basically there it is interest after tax by net proceeds. Here it is dividend, no after tax. Dividend is not a tax deductible item. Dividend by net proceeds, but on top of it there can be a growth. There can be a growth which gets added in the calculation. Dividend by net proceeds. What is net proceeds? Issue price minus flotation cost, or if it's CMP given, and if you issue the shares at CMP and if flotation cost is there, you consider it. Not there, ignore it. Okay. Issue price minus flotation cost or current market price logic in case there are flotation costs. This is if company is paying dividend. If company is paying dividend. There are companies which don't even pay dividend. Classic example, Microsoft. Microsoft did not pay dividend for a very long period. Did not pay dividend for a very long period. Any doubts first on this? D1? I'll explain. First is this formula. Present value of perpetuity equal to perpetuity amount of first year divided by rate of interest minus the growth rate. Present value means today's value, which is called P0. Today's value is P0. Price of share today. Price of share today. Perpetuity amount means what you get every year. What I get every year is dividend. Unfortunately or fortunately, dividend can keep changing. So we take dividend of first year. We take dividend of first year in the calculation. Dividend of first year in the calculation. Dividend can keep changing. Dividend can keep changing. Dividend of first year, otherwise called as D1. Otherwise called as D1. Rate of interest in this segment is called KE. It's not the same formula. I'm using the formula to derive this formula. Else I'll tell remember the formula. So rate of interest is replaced with KE. Growth rate is only growth rate. Interchange the formula. You'll get KE equal to D1 by P naught plus G. Mostly that formula only. If you have any flotation cost, which is rare data, if you have, do P naught minus flotation cost. Do P naught minus flotation cost. P naught minus flotation cost. Any doubts till this? P naught minus FC plus G. This is first scenario. Dividend paying company. If you are a dividend paying company, D1 by P naught minus F plus the growth rate. D1 dividend of next year. P naught issue price or current market price. F flotation cost. G growth rate. There are ways to calculate growth rate. All that I will explain as we proceed. Any doubts till this? This is first approach. If company is paying dividend. If company is paying dividend, you can follow this approach. Any doubts till this? Can we proceed? Second is non-dividend paying company. The first formula which you use, this formula is dividend paying company, and the formula name is called dividend growth model. It is basically called dividend growth model or dividend discount model. There are different names there. So I use the dividend growth model where growth can be zero. Say there are set of companies which never pay any dividend, are not likely to pay dividend for a longer period. Example, Zomato. Zomato may not pay dividends for a very long period because as of now only they are growing phase. They may not pay dividend. I can't say there's no cost of equity. Still that also has a cost of equity. How do we calculate that? We have to understand. Clear? Any doubts first on the first one? Can we proceed? Okay. Now non-dividend paying company. This we follow an approach called CAPM, capital asset pricing model. What is this model? Let us understand. At CA final, we spend around 10 hours only on this model itself. So I will not do in depth now. What is needed for you only that we will understand. Now, security return risk. Security return risk. Let's understand this now. A student is saying, can we note down? Not needed. Not needed because everything is there here. Dividend paying company. It is mentioned there. So noting down, your focus will be only on noting down rather than understanding things. That is why I normally don't tell you to note down. In case you wish to note down, then you see later, or I'll share this Word document if needed. But I don't want you to note down as of now. At least if you are able to do it at my pace, that's up to you. Very rare because I will be explaining, I will be typing, then I'll again explain. You start writing, you will miss my explanation. Coming to this, okay, security return and risk. There's something called as a GOI bonds, Government of India bonds. This will give me 6% return. Risk for this is zero. There's no risk for a Government of India bonds. Government of India bonds return is 6%. I ask what is the risk in this? You say zero. There's no risk at all. There is no risk at all in what is risk? Basically possibility of losing money. But in Government of India bonds, I don't see any possibility of losing money. I will get my 6% return without any variation. No variation, I will get my 6%. Then we have something called a stock market. In India, stock market is decided by two index called Nifty and Sensex. These are the two index. You do read about it for your better understanding. I don't want to explain much about what is Nifty, what is Sensex. But as a finance student, you should know what is Nifty, what is Sensex. So just read about it. In India, if somebody wants to know how stock market is going up or going down, they'll look at Nifty's return and Sensex return. Nifty comprise of around 50 companies. Sensex comprise of around 30 companies, and do read about it. Okay. Nifty and Sensex historically has given 14% return. Has given 14%, some random number I'm taking. This is perceived to be having risk of one time. This is a general rule, okay? Risk is one time. This is risk is 0 time. I have a risk of one time. I have a risk of 0 time. One time risk is there. 0 time risk is there. One time risk for stock market. Zero time risk for GOI bonds. GOI bonds do not carry risk, and stock market carry a risk of one time. This is a rule. This risk is measured through something called beta. How beta is calculated and all you will learn at final level. There is a way to calculate beta. This is the scenario. Okay. Now, what concept is trying to say here is ABC Limited has a risk of 1.5 times. Has a risk of 1.5 times. If it has a risk of 1.5 times, the return has to be more than 14. The return has to be more than 14 because risk 1 time 14, 0 time 6, more than 1 time more than 14, less than 1 time less than 14, closer to 0 closer to 6%, closer to 1 closer to 14%. Whatever you get here is the return an investor wants and is the cost indirectly company pays. The concept said it is the cost which the company is paying. It is the cost which the company is paying. If you see the definition, cost of equity, what does an equity shareholder want? What does an equity shareholder want? What is cost of debt? What does a debt holder want? What does a debt holder wants? What is cost of equity? What does an equity shareholder want? What does an equity shareholder want? One simple way, dividend by price plus growth is what an equity shareholder gets or what he wants. Gets or what he wants. See, if I say I earn 12%, it means company has paid 12%. It means company has paid 12%. If I earn 20%, company is earning 20%. So if somebody asks what is the cost of GOI bonds, for government it is 6%. What is the cost of Nifty? 14%. Similarly, what is cost of ABC Limited equity share? Cost of ABC Limited equity share. I am very clear it has to be more than 14. And how are we going to get it? Let us understand it. Okay. So what they say is very simple. Everything is there in the book. I know what is covered there. Cost of equity is equal to, first give me 6. First give the 6. 6 is what? Risk free. Plus 1.5 times. 1.5 times of the difference between 14 minus 6. Of the difference between 14 minus 6. 14 minus 6. Why 14 minus 6 difference? Because 14 minus 6 is the extra for one time. 14 minus 6 is the extra for how many times? One time. If you are at 1.5 time, get 1.5 time of the difference. Get what? 1.5 times. 1.5 times of what? Difference between 14 minus 6. Difference between 14 minus 6. Difference between 14 minus 6. Can you tell me what is the answer you get here? I'll come to the formula in some time. Okay. 18%. Another company has beta of 0.5. If you are at 0.5, you will be less than 14, greater than 6. Less than 14, greater than 6. Less than 14, greater than 6. What's the answer you get? 10. Very rare, but let us take it as 0 time. 0 time means you will end up getting RF answer itself. You will end up getting the GOI bond answer itself. You will end up getting the GOI bond. You can do the calculation. 6 plus 0 into 14 minus 6. 0 into 14 minus 6 is 0 only. 0 into 14 minus 6 is 0. So this number is another company. One time. One time means you will get the stock market number. You will get the stock market number. You will get the stock market number. More than 1, more than 14. Less than 1, less than 14. What is the logic of this? Higher risk, higher return expectation, higher cost of equity. Higher risk, higher return expectation, higher cost of equity. Lower risk, lower return expectation, lower cost of equity. Lower cost of equity. 1 time into 14 minus 6 is what? 14%. 14%. So the formula which you have for cost of equity is, no need to write the formula, RF. RF means risk-free rate. RF. What is RF? Is Government of India rate. RF is risk-free rate plus beta. Beta can be 1 time, 1.5 time, 2 times, 0.5 times. When do I use this formula? If you're not paying dividend, I want to get, if you're not paying dividend doesn't mean that's a free money. It basically means that you have to keep increasing the price significantly and in the end give the shareholder money after few years. How many years we don't know. And this is RM minus RF. RM minus RF. RM minus RF. What is RM? Market return. What is market in India? Stock market, which is Nifty or Sensex. Stock market is what? Nifty or Sensex. I'll share this Word document to you. You guys note down if you wish, but I don't see a need at all. You can go through the Word document later and maybe make extra points in your concept book itself if needed. In the concept book itself, write extra points if needed. Not there, not needed, then leave it, okay? So you see here the formula. RF plus beta into RM minus RF. RF is risk-free rate. RM is market return. RM is market return. RM is market return. Cost of equity, I've done so many calculations. I can do like this. RF plus beta into RM minus RF. RM minus RF. RM minus RF. What can be the beta? It can keep changing. There is a concept of negative beta also. Negative beta means your cost of equity will go even lower than 6. Will go lower than 6, but mostly they won't test in exam. But there can be a negative beta also. How beta is calculated, we learn at CA final, okay? RF plus beta into RM minus RF. The beta can be 0 time, 0.2 times, 1 time, 1.5, 2. As the beta increases, risk increases, KE increases. Risk increases, KE increases. As the beta increases, risk increases. If I take fixed deposit, risk increases, interest rate on the FD increases. Interest rate on the FD increases. Cost of equity increases. Cost of, as one concept of finance is very simple. As risk goes up, return has to go up. As risk goes up, return has to go up. As risk goes down, return has to go down. So if beta increases, KE will go up. Beta decreases, KE will go down. Now what ICAI can do sometimes is, they will say do KE using this formula, do KE using this formula, and then use it in this formula and value the share. Value the share. They have done this also. KE, we see for KE I need price and dividend. They'll give dividend, but they don't give price. They don't give price, and they ask you to value the price. How will I do? KE, I will use the second formula. Substitute in the first formula, price becomes balancing figure. Substitute in the first formula, price becomes balancing figure. This is a usual CA final question. They will ask you to calculate KE using the second formula, substitute that in the first formula, and then value the share. And then value the share. Dividends are getting paid, but I need D1, P0. D1 you give, P0 you don't give. KE also you don't give. How will I calculate? D1 given, KE is also given. I can calculate P0. So KE may be used, calculated using formula 2 and used in formula 1. Any doubts till this? Okay, only one variant you have to be aware. Sometimes instead of giving stock market return, they may give risk premium of stock market or return premium of stock market. What is risk premium or return premium is, instead of giving you 14, I'll give you the difference. What is difference is 8%. I don't want to give you 14. I give you 8% directly. If I give you 8% directly, don't write 8 minus 6. Directly do into 8. Directly do into 8 in the formula. I'll repeat again. I'll give you RF. I'll give you RM. Do RM minus RF. Some question I don't give you RM. I give you return premium of market or risk premium of market. Premium means extra. Extra. How much extra is the stock market giving? How much extra is the stock market giving, how much extra is the stock market giving? That extra is 8% here. That extra is 8%. So what students do in a hurry is they'll use the word risk premium of stock market. He is in a hurry, he will do 8 minus 6. That is wrong. You can't do 8 minus 6. If they give 14, do 14 minus 6 with the word market return. Can the market return be 8 also? Yes, it is possible. If they say market return 8, do 8 minus 6. But if they say return premium of market or risk premium of market, that indirectly means the gap between the two. That indirectly means the gap between the two. Able to understand till this? I will do questions around this in some time. Any doubts till this? So they may give the word RM minus RF, risk premium of market. What is this RM minus RF? Some question. I don't have an example here, but there could be an example where they may give RM minus RF directly itself. Clear? I've just explained two methods. We'll be explaining other methods post the break. I've explained you two methods. One is called dividend paying company. Second is called non-dividend paying company. Dividend paying company, dividend of first year are called as D1 divided by cost of equity minus growth rate, interchange D1 by P0 minus F plus G. D1 by P0 minus F plus G. Non-dividend paying company, our CAPM approach, they specifically use the word RF plus beta into RM minus RF. RF plus beta into RM minus RF. In this, if at all ICAI wants, they may give cost of equity, beta, and tell you to calculate RM or tell you to calculate RF. Anything can be asked. Any doubts on this? Is this covered in the book? Yes, it is covered here. D1 by P0 minus F plus growth rate. How the formula has come, I have not explained that. That explanation I have given here. You have already know the other formula, so no point in noting it down. RF plus beta into RM minus RF. Only thing you can note down here, please note down. Beta of risk free. Beta of risk free 0. Beta of risk free 0. Beta of market 1. This is a rule. Risk free 0, market is 1. Risk free 0, market is 1 time. Risk free 0, market is 1 time. There are other approaches which I'll explain later because these two only is very critical. We'll be doing questions on this and then we'll come back to other approaches. Beta of risk free 0, beta of market is 1 time. Any doubts till this? Clear? Understood? Done? Any doubts till this? Okay, let's take a break now then. What is dividend of next year? I think this got missed out in the material. You may note it down. Just give me a minute. Should be there, but yeah, you noted down. Okay, what is dividend of next year? What is dividend of next year? Growth rate is 10%. Growth rate is 10%. Some have got missed out. Growth rate is 10%. Okay. Now listen. It says last paid dividend. Dividend of last year. Dividend paid now. Last paid dividend. Dividend of last year. Dividend paid now. Equal to rupees 10. This is D0. If they use word like this, last paid dividend, dividend of last year, if such words are there, it is D0. Such words are there, it is D0. This is D0. D0. Next year dividend equal to 10 plus 10%, 11. Last paid dividend, dividend of last year, dividend paid now, 10 plus 10%, 11. 10 plus 10%, 11. If the words are like this, okay, dividend paid last year, last paid dividend, dividend paid now, such words are there. Take it as D0, add the growth. Dividend of next year, end of current year, future dividend, dividend will be paid next year, rupees 10, rupees 10. This is D1. No growth to be added. This is D1, no growth to be added. Okay. Now there can be a situation. Any doubts to this? Listen. Question uses a word dividend per share rupees 10. Listen for 2 minutes. Okay. Dividend per share rupees 10. No clarity whether this is D0 or D1. It just uses the word dividend per share rupees 10. Or they give a income statement and we compute, listen, I'll give you time. We compute dividend per share. From an income statement, I do some calculation, calculate dividend per share. I don't know whether it is D0 or D1. I have an income statement. I calculate the dividend. They say following is the annual report of the company. With the annual report of the company, I prepare an income statement. With the income statement, I calculated one dividend per share. Or it said dividend likely to be paid. Likely to be paid is story okay, but when? Is it 1 month, which is like D0? Is it 1 year, which is like D1? Dividend likely to be paid, understood. When is it going to be paid? If crystal clear words are not there, we'll have to take assumption and only solve it. This is one issue which this entire chapter has. Goes on till CA final also. There will be confusion whether the given dividend is D0 or D1. 3 questions till now I did not have any confusion. The 4th question which is there's a confusion there. That's why I wanted to touch the concept and then go there. 4th question which I'm going to do there I have a confusion whether to take it as D0 or D1 because clarity will not be there. Clarity will not be there. So like DPS of 10, income statement we compute DPS, dividend likely to be paid. Like this there's no end. Okay, you can have multiple scenario where clarity is not there. Where clarity is not there, we'll have to take an assumption. Clarity not there, no clarity, assumption to be taken as D0 or D1. You change the assumption, answer will change. You change the assumption, answer will undergo change. This part I think somewhere it is, I didn't cover it as a separate concept, could have covered it. If clarity is not there, when is the dividend going to be paid? See, concept is very simple. If it's going to take more than 6 months, it is more like D1. If it's going to be less than 6 months, it is more like D0. D0 means today. D1 means later, at the end of. If the time period is closer to end of year, D1. If the time period is closer to today, D0. This is concept in the practical world. In exam, obviously, I don't know when the dividend is going to be paid. Timing clarity is not there. please take assumption. Timing clarity is there, take D0 or D1. Next question, when I do, you'll understand. There will not be clarity. Any doubts till this first?
And dividend of next year 10.
These are different scenario. I'm saying the question used the word 10 rupees and used such words. Do 10 plus 10%. Question used these words for same 10 rupees. If the same words are used for 10 rupees, take that as D1 and don't do any extra adjustment now. Don't do any extra adjustment now. Same problem says last paid dividend 10, add 10%. Same question says dividend of last year 10, add 10%. Dividend paid now 10, add 10%. Dividend of next year 10, don't add 10%. End of current year 10, don't add 10%. Future dividend, don't add 10%. Dividend will be paid next year, don't add 10%. So when you add, when you don't add is what are the two scenarios, okay? These are not problems for us to solve. These are just two scenarios for you to explain. Then it says DPS 10. When is that DPS 10? DPS 10 is okay. Is it going to be paid now? End of current year? End of next year? When is it getting paid? I don't know. Take assumption. Take assumption. You prepared an income statement. Calculated dividend. What is income statement? Sales is there, variable cost, all that you did. Profit before tax, profit after tax, and calculated dividend per share. After I calculated dividend per share, is that dividend D0 or D1? Is that dividend D0 or D1? When is it D0? Closer to today. When is it D1? Closer to end of first year. Closer means less than 6 months, more than 6 months. Not exactly that way, but the concept is this. If it's closer to today, take it as D0. Closer to end of year, take it as D1. When we did cost of debt, we did not have all this headache. Reason is in the debenture, interest doesn't change. Whether you call it as I1 or I0 doesn't matter there. But here dividends do undergo change. So should I use 10 in the numerator or 11 in the numerator? Same question. If they use the word anything like this, then you do 11 in the numerator. If they use any words like this, you use 10 in the numerator. If they give anything like this, you will take assumption. You will take assumption. Any doubts till this? Can we proceed? Done? Okay. Next is this concept and all is there. No, nothing for you to note down now. How to compute growth rate? Let's understand this now. How do I compute growth rate? Because growth rate till now was given in the question. But if it's not given, how will I calculate the growth rate? Because we did two questions. Growth rate 5%, 10%, negative 5%, negative 10%, everything was given. But there will be question where growth rate won't be given. You need to take extra effort and calculate the growth rate. So I am yet to complete this concept fully, okay? I'm still, because there are 3 more methods. Now I'm moving to an area called how do I compute growth rate, okay? Now let's understand this first. Okay, listen, growth rate depends on 2 things, ROE and something called as retention ratio. What is this ROE into retention ratio? Let us understand this. A company had a capital of 100 rupees. Okay, there's a formula for return on equity. All that later doesn't matter for you at this point of time. Okay, in case formula is needed, I'll explain. But ratio analysis where you will learn this. 100 rupee capital was there. We are earning 20% on 100. 20% we are earning means 20 rupees is the earnings. In this 20 rupee earning, I pay dividend of 25%. I pay dividend of 25%. 20 rupee earning, 100 rupee capital, 25% is the, 20% is the ROE. ROE is what return are you generating on that 100. Return on 100 rupees is the equity capital. ROE 20%. Return on the equity capital 20%. Earnings per share is 20 rupees. One share only is there. Okay. In that 25% is dividend. This is called payout ratio. Whatever dividend we generate, whatever earnings we generate, we can do 2 things. Either pay as dividend or retain it as retained earnings for the next year. Retain it as retained earnings for the next year. So this 20 into 25% will give me dividend per share 5 rupees. Dividend per share 5 rupees. What is the balance? Balance is retained earning 15. Retained earning 15. Balance is the retained earning 15. Now good thing happens is next year my capital is 115 because I retained money. If I retain 115, I will earn 20% on this. I will earn 20% on this. So my earnings from 20 will go up to 23. Earnings from 20 will go up to 23. I'll repeat again. 100 rupee capital, 20% earned, EPS 20. In the earnings per share, you can do two things. You can give it as dividend or retain it in the company. If you retain 75% retain, paid out 25%, dividend 5 rupees given, retain earnings 15 rupees. Good thing about this 15 rupees is now 100 has become what? 115. If you continue to earn 20%, that's our assumption, okay? I will earn 23. On this 23, I will pay 25%. I will pay 25%. Dividend now will become 5.75. Retained earnings will become 23 minus 5.75. Now listen. 100 capital has gone up to 115. 100 capital has gone up to 115. 15% increase. 15% increase. Earnings 20 has gone up to 23. 15% increase. 15% increase. Dividend 5 rupees has gone up to 5.75. 15% increase. 15% increase. Retained earnings 15 rupees has gone up to 17.25. 15% increase. Every item is increasing by 15%. Every item is increasing by 15%. I'll repeat again. Last year 100 capital. This year 115 capital. Last year 20 rupees you earned on 100. Now you earn 23 rupees on 100. How 23 into 20%? Into 20%. Last year you paid 25% dividend, retained balance. This year you pay 25% dividend, retained balance. Every item has gone up by 15%. Every item has gone up by what? 15%, which means growth is 15%. Which means growth is 15%. There is a formula for the growth. First is the logical discussion, okay? The formula is ROE 20%, retention 75%. ROE 20%, retention 75%. I will grow at the rate of 15%. I'll grow at the rate of 15%. ROE into retention ratio. ROE into retention ratio. Wait for some time. ROE into retention ratio. Now in the same example, suddenly he is saying I will do 20, 40% only I will retain. 40% only I will retain. Growth will become only 8%. I'll repeat the numbers. You will see 8% growth only. You will see only 8% growth. When what? Retention is 40%. Payout is 60%. Payout means what dividends we are paying. Retention means what is the retained earnings. Formula is ROE into retention ratio. Should you remember the formula? Logic I've explained. But yes, you may want to remember the formula. But logic is ROE into retention ratio. Listen. ROE 20%. Retention can be 10, can be 20, can be 30, can be 40. Microsoft for a very long period had 100% retention. 100% means no dividend was paid for a very long period. Reason? They were growing at a rapid rate. They needed money. For 20-25 years, Microsoft did not pay dividends. Thereafter, they started paying dividends. When money was highly available, they started paying dividend. When you start paying dividend, your growth will come down. Growth will come down. Why is the growth coming down? Because I don't have money to invest now. I'm paying dividend. No, if I don't pay dividend, I will add it to capital. If I add it to capital, I will earn more profit. More money, more profit. Earlier, we were earning 20% on 100. Now we will start earning on more. So formula is what? ROE into retention ratio. ROE into retention ratio. Now I'll prove this 8% calculation. Okay. Listen. I started with 100. Earned 20%. EPS 20. Dividend is 60%. Dividend is 60%. So dividend per share is 12. Retained is 8. Balance 8. This goes to the next year. You have now 108, 8% increase. 108, 8% increase. 100 has become 108. I earn same 20%. 21.6. I pay 60%. Retained is 8.64. Every item will be up by 8%. Will be up by 8%. Any doubts on this first? Any doubts on this logic? First is this logic. Logic is very simple. ROE into retention ratio. ROE into retention ratio. ROE into retention ratio. Any doubts on this? Can we proceed? ROE into retention ratio. Any doubts on this? Can we proceed? Clear? Okay. So ROE, there's a formula for ROE and all. I'll discuss that later. Ideally, we should have done ratio analysis and come here, but I felt this is important. So we started here. ROE into retention ratio. Any doubts till this? Can we proceed? Understood the formula? ROE into retention. Retention means 100% minus the payout ratio. Our payout ratio is 100% minus the retention ratio. Any doubts on the numbers till this? Okay. Then there's another way also. Another approach is dividend data is given, history is given. 10 rupee dividend, 11 rupee dividend, 12 rupee dividend, 13.5 rupee dividend, 12.5 rupee dividend, 14 rupee dividend, 18 rupee dividend. This is year 0, okay? First year, second year, third year, fourth year, fifth year, sixth year. History is given, okay? Starting with year 0. Ignore all this in between. Ignore all of this in between, okay? Ignore all the data in between. They have given historical data. Year 0 is there. Year 6 is there. Sometimes they'll say dividend of 10 of year 0 became 18 in year 6. They don't even give anything in between. If they give this, present value is equal to future value into present value factor R comma N. R comma N. What is present value? 10 rupees. What is future value? 18 rupees into PVF R comma 6. R is the growth rate. 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 They may have to give a present value factor. They may have to give a present value factor. Everything is there in the book. Understand, okay? Present value is equal to time value of money. I keep going back there. Present value is equal to what? Future value into present value factor. R. Future value is equal to present value into future value factor R comma N. What is future value? 18 rupees. What is present value? 10 rupees. FVF R comma 6. Question may give you future value factors or present value factors. With that you calculate it. Future value factors are present value factors, and with that you have to calculate, because you will get the FVF and then look at, is it 1% matching, 2% matching, 3% matching, 4% matching, 5% matching, 6, 7, 8, 9, 10, some percentage has to match, or it could be in between also. We'll see what to do with that all later. Any doubts on this? So two ways of calculating growth rate based on earning ability, ROE into retention ratio. There's a formula. Don't understand the formula as of now. In case needed, I'll tell you to remember the formula, but I'll have to discuss in ratio analysis. Ratio analysis, we learn this formula, okay? Based on past dividend history, present dividend. Present means in the history data, in the historical data. Prior period is called present value. Future period, 1995 to 2005, you have 95 dividend is present value, 2005 dividend is future value. 2005 to 2015, you have 2005 is present value, 2015 is future value. 2025 to 35, you have 25 is present value, 35 is future value. Earlier dividend, later dividend. Then apply the formula. Future value equal to present value into FVF R comma N, or present value equal to future value into present value factor R comma N. Any doubts on the concept? Two ways of calculating growth rate. ROE into retention ratio, or take the historical data, take one dividend as present value, take one dividend as future value, one dividend as present value, one dividend as future value, one as present, one as future, and then do the calculation. One as present, one as future, and then do the calculation. Able to understand this? Any doubts on this? Now, some exam question may change the word. They may use the word IRR. IRR means internal rate of return. ROI, return on investment. Rate of return. Basically, I need to use that 100 rupees there, no? On that 100 rupee, what percentage we earn? That can be called as ROE, ROI, IRR, rate of return. Different words can be used in the question. Any doubts on the concept here? Any doubts on the concept? What is the formula for growth rate? Participate. ROE into retention ratio are based on the past history. Based on the past history. As we do the question, if needed, I'll touch upon more on the ROE formula. If not needed, I'll touch in the ratio analysis chapter. Any doubts on this? Can we proceed? Okay, we go to the third approach of cost of equity, which is called realized yield approach. Guys, realized yield approach. Let's understand what is this realized yield approach. Realized yield approach is same as cost of debt using YTM method. Using YTM method. What is using YTM method? As an investor, I will calculate. As an investor, I'll calculate year zero outflow. First, second, third, fourth, fifth, sixth, some years they'll give. You will get dividend income, and at the end you will sell the share. At the end you will sell the share. They'll give data on everything. They'll give dividend data, and at the end there will be sale of shares. There will be sale of share. For this, we are going to calculate IRR. IRR is basically year zero outflow. 1, 2, 3, 4, 5 some inflow. Year 5 another inflow. Start with one discount rate. Get a net positive, NPV positive. Do another discount rate, maybe negative, and apply the formula of the IRR. Apply the formula of the IRR. So realized yield approach is nothing but IRR from the investor point of view. IRR of investor is equal to return of the investor equal to cost of the company. Return of the investor is cost for the company. Cost for the company. We have done three approaches I've explained: dividend paying company, non-dividend paying company, realized yield approach. This approach is never followed in question unless they specifically say follow earnings based approach. Best is dividend based approach because dividend is paid out. Earnings based approach means D1 is replaced with E1 in the formula. That's all. D1 is replaced with E1. Formula and all is same, but never followed, and you should not follow unless they specifically say earnings based approach. If they specifically use the word earnings based approach, then that's a different story. Earnings based approach is never followed by us. Specific word is there, I can't do anything. Any doubts till this? Can we proceed? Okay, there's one more approach called based on P. These two approaches, this you will follow only question specifically tells. Last one is followed when nothing else is possible. I'm not able to do dividend paying company, not able to do non-dividend paying company calculation, not able to do realized yield approach calculation, not able to do earnings based, leave it. Earnings based is never come into picture. Not able to do the three. If you're not able to do the three, can you try the PE multiple approach? Is the logic we are bringing it. Okay. Now let me explain what is this PE multiple logic. I'll explain. So three approaches we have learned. All the three are what is frequently tested and used by us. Even not three, the first two only is frequently used by us to solve question. Now last approach is called PE multiple approach. Now let's understand what is this. The approach name is called price earning multiple. What does price earning multiple is? Listen for some time. Price of share divided by earning of share. Price of share divided by AC remote is there. price of share divided by earning of share. Again, the formula ratio analysis will discuss depth, but here I am discussing because I need this now. Price is called P0. Earnings can be called as E0, E1, whatever name you want to call. Now, KE they are saying is inverse of this. There's another formula they've introduced for KE, which is what? Inverse of this. Inverse means what? E1 by P0. E1 by P0. Now, ICAI in their material, when they explained also, they said this formula should be used when there is a payout ratio of 100%. Payout ratio of 100%. Payout ratio of 100%. Explanation is there in the material. Listen. If something is to be written, I'll tell you. Payout ratio of 100%. If the payout ratio is 100%, what is retention? What is growth? 0. So in the formula, you can add growth also, but growth is 0. Growth is 0. If the payout ratio is 100%, will the dividend and earnings be same? If the payout ratio is 100%, will the dividend per share and earnings per share be same? So this can also be called as D1. Or to put it very simple, it is our original formula. D1 by P0 plus growth rate. D1 by P0 plus growth rate, but that is complicated and becomes 1 by P multiple, but only condition is payout ratio 100%. If payout ratio is not 100%, logically this can't fit in. But still, no other option available. Payout ratio is not even 100%. Practical world also people use it, and in class also we will use 1 by P multiple if nothing else is possible. If nothing else is possible, I'll explain it again. Price earning. Formula is price of share divided by earning of share. Price is called P0. Earning is called E0, E1, everything same, only no growth. E0, E1, E2, E3, because 100% payout is the logic. E0, E1, E2, E3. They are saying if this is there, KE can be inverse of P. When I say inverse, inverse of this formula. What is inverse? E1 by P0. E1 by P0. E1 is nothing but D1. E1 is nothing but D1. E1 is nothing but D1 plus growth also you add in the formula, but growth is 0. Growth also you add in the formula. So our usual formula, listen, D1 by P0 plus growth. If growth is 0, the formula becomes D1 by P0. The formula becomes what? D1 by P0. And if there is a 100% payout, D1 becomes E1. E1 by P0. And if you take inverse of this, it's called P0 by E1, price by earning. Price by earning. So they gave another formula called inverse of P multiple, but which is nothing but same as dividend paying company. The explanation is there. P multiple is price by earning. Inverse of P multiple, earning by price. Earning by price. Earning by price. What is earning by price? Earning by price is nothing but dividend by price. Earning by price is nothing but dividend. Dividend by price. I have written very clearly. KE can be taken as inverse of P multiple if data about other methods is not available. Data about other methods is not available. I'll again repeat. This P multiple approach is nothing but same as our first formula. Same as our first formula. What is the first formula we did? The first formula was P0 is equal to, K is equal to D1 by P0 plus growth rate. Ignoring flotation for the time being, okay? D1 by P0 plus growth rate. D1 by P0 plus growth rate. D1 is called E1, P0 is called P0, inverse is called P multiple. Inverse is called KE, inverse is called P multiple, P multiple inverse is called KE. KE inverse is called price earning multiple. Price earning multiple inverse is called KE, is called KE. Any doubts in this? I'll repeat the entire part now. We started with dividend paying company. Participate, dividend paying company. What's the KE formula? D1 by P0 minus F plus growth rate. What is D1? Dividend of next year, which can be dividend of current year into 1 plus G, into 1 plus G. Can the growth be negative? Yes, the growth can be negative. Then we learn P0. What is P0? Current market price, rare scenario, issue price. Rare scenario, issue price. Whenever there is a issue price, with that flotation cost may come. Till now, none of the problem we had issue price data, and none of the problem we had flotation cost information also. But denominator can be what? Issue price minus flotation cost. Issue price minus flotation cost. Any doubts till this? CMP or issue price, and F is equal to what? Flotation cost. Then we did non-dividend paying company. Non-dividend paying company was the formula RF plus beta. Nothing, look at this chart. Okay, RF plus beta into RM minus RF. What is RF? Risk-free rate. What is beta? Measures risk of a company. What is RM? Market return. RM minus RF is called risk premium of market, or other name is called return premium of market. Risk premium of market or return premium of market. Then realized yield approach, IRR of the investor. What is IRR? We'll have to do year, cash flow, PVF, DCF, year 0 outflow, first, second, third, fourth, fifth inflow, sixth, seventh, whatever number of years, and then you sell it. Start with one discount rate, get a positive NPV or negative NPV, use another rate, get one positive, one negative. What's the formula for IRR? L1, participate, L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1, L2 minus L1, which is the next segment we learned. Then we went ahead and saw earnings based approach, or even in realized yield approach, one question we saw geometric mean. What is geometric mean? Is calculate return for every year, 1 plus first year return into 1 plus second year return into 1 plus third year return into 1 plus fourth year return, whole multiplied, power 1 by 4 and deduct the 1, power 1 by 4. 3 years, power 1 by 3. 2 years, power 1 by 2. 2 years you can handle, 4 years you can handle, 3 years your calculator can't handle. Okay, calculator can't handle. There are other ways to do it, which are all we'll see later. Any doubts till this? Understood? Okay. Once I get this answer, I then proceed ahead and see another approach called earnings based approach, which basically said E1 by what? P0 minus F plus growth rate. Is it a new formula? No. D1 is replaced with E1. The revised E1 by P0. See, E1 by P0. My F is not there. E1 by P0. Growth is also not there. E1 by P0 inverse is called P KE, or E1 by P0 inverse is called P multiple. E1 by P0 inverse is called what? PE multiple. PE multiple. Last formula. Use it where everything else fails. Where everything else is failing. Any doubts on this? Then we learned how growth rate is calculated. Growth rate is calculated as ROE into retention ratio. ROE into retention ratio. ROE into retention ratio. That is one formula. There is a formula for ROE. All that as of now not needed. ROE can be called as IRR, ROI, ROE. Different names are there. And second is based on past data or future data, whatever. I need some data. One dividend take us present value. One dividend take us future value. Present value equal to future value into present value factor. Future value is equal to present value into future value factor. Our present value is equal to future value divided by 1 plus r power n multiplied with 1 plus r power n, and you can take square root and get to the answer if possible. Any doubts till this? Understood? Okay. I'll discuss the concept. Maybe we don't solve the question today. I'll discuss the concept, which is called cost of retained earnings. Now listen. Equity, when I explain, equity is of two types. One is called internal equity. Second is called external equity. Till now we have been focusing on external equity. What is external equity? I issue shares, get money, or I issued shares in the past and I use that money. There's another form of money which people get or which companies get, which is called retained earnings. Listen, if company makes profit after paying equity dividend, after paying preference dividend, the entire money, I am the owner of that money. I am the equity shareholder. I am the owner of that money. That money, instead of giving it to me, the company keeps it with themselves. The company keeps it with themselves instead of giving it to whom? To the shareholder. Why are they keeping? They are promising me, saying that, don't worry, I will retain the money and I will earn more. And in future, I'll give you more money. Future, I'll give you more money. Retained earnings doesn't mean free money for the company. That also has a cost. That also has a cost. Retained earnings is nothing but same as cost of equity. Reason very simple. See, what is cost of equity? What does an equity shareholder wants? What is cost of retained earnings? Same. What does an equity shareholder wants? What does an equity shareholder wants? Whatever equity shareholder wants is nothing but cost of equity or cost of retained earnings. Some exception are there. That alone I have to discuss. Okay. Some exceptions are there. What is KE? KE is cost of equity. What does a equity shareholder want? What is KD? Cost of debt. What does a debenture holder want? What does a debenture holder want? See, from company point of view, it is called cost of debt. From your point of view, it will be called return on debentures or return which you want. Return which you want. What is cost of equity? From my point of view, it's called cost for the company. From your point of view, you will call it as return on the equity. You will call it as return on the equity. You will call it as return on the equity. Return on the equity. Clear? Able to understand this? Any doubts till this? Okay. Now, cost of retained earnings is same as cost of equity. Only two things you have to keep in mind. Flotation cost. If there is a flotation cost, our formula says D1 P0 minus F. What is flotation cost? If I issue any new shares, I'll incur flotation cost. On the retained earnings, money is there in the company. There can't be any flotation cost logic in the formula. There can't be any flotation cost logic in the formula. Whatever problems we have done till now, every question KE and K are same because I did not find any flotation cost in any problem. KE, every question we have done, that is not cost of equity. That is also cost of retained earnings. That is also cost of retained earnings. Now you will see question with flotation cost. So which I'll do it in the next session. I'm not doing it today. But if there is a flotation cost in the formula, don't write minus F. Don't write minus F. P0 minus F is replaced with P0 in K formula. Somebody is saying, I am not using this formula itself. I am using the formula called RF plus beta into RM minus RF. And I don't have any data on flotation cost. K, K are same. K, K are is same. If you are using the formulas, what? RF plus beta into RM minus RF. KE, K are same only. There's no difference. There's no difference between the term cost of equity and there's no difference between the term cost of retained earnings. Other point is for P0, when you do cost of equity, if I'm making a new issue price first preference, current market price is the second preference there. Even when we did your cost of debenture, you will remember net proceeds, I always used to say issue price minus flotation cost. In retained earnings alone, CMP is the first preference. CMP is the first preference and the second preference is issue price. Everywhere else, cost of debt, cost of equity. When you learn cost of preference, issue price is the first preference, which is not issue price. It's issue price minus flotation cost. It is issue price minus flotation cost. Here alone, CMP is given first preference, which is very logical because I don't issue anything here. This is one part. Second is if they give you personal tax. If they give you personal tax, which is a rare scenario, but if they give personal taxes in the question, if they give personal taxes in the question, what happens we'll understand. Okay. First is P0 minus F is replaced with P0. And what is P0? CMP, first choice. Second choice is issue price. Second choice is issue price. If There is no data of both, only one data is there. Please take that. Don't worry. Don't worry about that. If only one issue price is there, take it. Only one CMP is there, take it. Both are there. Cost of equity, our logic could be issue price minus flotation cost, because I'm issuing a debenture today. I'm issuing a share today. Retained earnings, you don't make any issue. Retained earnings, you don't make any issue. So the logic here is CMP is first preference, issue price is second choice. Second part is, now let's assume cost of equity is 20%. This 20% is on the higher end. Listen. KE, when I calculated, I did 20 by maybe, or whatever number, okay, don't worry about the numbers, okay. I did 15 divided by 100 minus 3, some flotation cost I subtracted. If I do 15 divided by 97, I get 15.46%, okay. In retained earnings, we do 15, only divide by 100, we'll get only 15%. So obviously, one thing which is very clear is retained earnings as a cost lower than the other one. Retained earnings as a cost lower than the other one. How can I do this lower one? KR is equal to KE into, there's another element, okay. Flotation cost is only one element. 15.46, 1 minus 3% flotation cost. 3% flotation cost. 3% flotation cost. Can you do 15.46 into 0.97? Are you getting 15%? 15%. Listen, here you do 15 divided by 100 minus 3. Here you do 15 divided by 100. If only flotation cost is there, do this, okay. But with that flotation cost, there's one thing else also. One additional thing I want to discuss. So formula says KE into 1 minus what? Flotation cost percentage. 1 minus flotation cost percentage. 15.46. Bring it down to 15. But there's one more element. Listen. In equity, what do companies pay for equity shares? They pay dividend. If I receive dividend, I may have to pay income tax on that dividend. Whereas on retained earnings, I don't get anything. So where is the point of tax? So they say you also need to do into 1 minus personal tax rate. Personal means shareholder tax rate. Very rarely they'll give 1 minus what? Personal tax rate. 1 minus, see, 15.46 is cost of equity. Retained earnings is already at 15 only. On top of it, taxes are not paid. Cost further goes down. Taxes are not paid. KE, higher cost, because you pay flotation cost, you also pay personal tax. You pay flotation cost, you also pay personal tax. Very rarely used formula. KR is equal to what? KE into 1 minus flotation cost. Why 1 minus flotation cost? This will bring it down to 15. Please bring it down further by doing deduction of what? Deduction of the personal taxes, because personal taxes are not paid. There you pay higher cost. Here you don't pay. So 1 minus personal tax. Very rarely done. 1 minus personal tax. Listen. One question give you personal tax data. Follow the second formula. KR equal to what? KE into 1 minus personal tax into 1 minus flotation. Only personal tax given, second logic. Personal tax and flotation cost given, second logic. Only flotation cost is given, come to the first one. Only flotation cost is given, come to the first one. What is first one? P naught minus F is replaced with P naught in the formula. So what will I do? I'll first calculate KE, then I'll do KR equal to KE into 1 minus personal tax rate into 1 minus flotation cost percentage. If only flotation cost is there, when you do your KE formula, you would have done P naught minus F. KR formula, just do P naught. Now, let us see this example, which is where a concept gets tested. Y limited retains, example 19, 7,50,000 out of its current earning. Expected rate of return to the shareholders if they had invested the funds elsewhere is 10%, brokerage 3%, shareholders come in 30% tax bracket. Shareholders come in 30% is personal tax rate. Personal tax rate, calculate cost of retained earnings. Nothing for you to write. Listen. This is the formula KR. In this information, do you find KE anywhere? Is there a cost of equity given here? 10% is what my shareholder wants, and that is technically called as cost of equity. That is technically called as cost of equity. Whatever an equity shareholder wants is nothing but cost of equity. Cost of equity means what company is paying or what investor is wanting. What investor is wanting. Nothing to write, okay? 10 into 1 minus personal tax rate. 1 minus personal tax rate, which is there in the example. What is the personal tax rate? 0.3. Flotation cost 0.3. Do the calculation. That's all. 10 into 0.7 into 0.97. 10 into 0.7 into 0.97. How much? Ten into 0.7, 0.97. 0.7, 0.97. Clear? Done. Any doubts on this? Can we proceed? Clear? Now we move to cost of preference. Listen, cost of preference you see here is exactly same as cost of debt. Preference also three things are there. Irredeemable, redeemable, even convertible can come. Where is the difference? Only difference is interest after tax is replaced with preference dividend in the calculation. Only one change. Interest after tax is replaced with preference dividend. No, after tax. Preference dividend is not tax deductible. Is not tax deductible. So what is the formula? PD by net proceeds or PD plus RV minus NP by balance life divided by RV plus NP by 2. Or IRR approach. What is IRR approach? The net proceeds is initial outflow, PD is in between 1 to so many years inflow, and redeemable value is the final inflow. Any doubts on this? Do you find there's no difference at all? Okay. How net proceeds is calculated? Same logic. If the issue had happened earlier, then current market price. If the issue is happening today, issue price minus flotation cost. You can look at the chart. There's no difference at all. Irredeemable cost is preference dividend by net proceeds. There it is interest after tax by net proceeds. So that's why I'm not explaining much here. Approximation method, PD plus AOC by AFE, RV minus NP by balance life divided by RV plus NP by 2. IRR method. In the IRR method, you take the net proceeds to be the initial outflow, PD to be so many years inflow, RV to be the terminal means end of the project inflow. Can there be a convertible preference? Yes. If there's a convertible preference, same logic you'll have to follow. Same logic. Just give me a minute. Just write here also in the side. I don't know. I have not added it here. Convertible. In fact, I have used the word debt, so you can change it as the word preference. Preference. And the third one is convertible. Same approach. Convertible, same approach. If there is a convertible, it is same approach. Convertible will go through the same approach. Convertible means you will have to take the same thing which is higher of convert into equity, redeem it as preference. Redeem it as preference, convert to equity story. Can we proceed? Okay, with this, the base is ready. Now we are going to move to an area called WACC. WACC. What is this WACC? Let's try to understand that. But our base is ready. What will get tested in exam is WACC. But are we going to learn anything new in WACC? Unfortunately, no. It is what we have learned till now will only be used there. Now understand this. Let's assume I have debt, equity, preference, retained earnings, term loan. There are term loan is also debt only. Debentures can be there, term loans can be there, bonds can be there. Everything can have a different cost. This is 10%. This is 15%. This is 12%. This is 14%. This is 6%. Now, all of this, I want a single average number. I want a average number. One option is to do a simple average, which is not acceptable. Okay. One option is to do a simple average. Simple average means just add the 5 numbers, divide by 5. We do something called as weighted average. For weighted average, tell me how will you do weighted average? Normally, what you do for weighted average? If at all anywhere you have to do weighted average, what did you learn in maths? Into some weights you have to do. So into maybe 10, 20, 30, 40, 50, you will put a total and divide by the total of the weights. Divide by the total of the weights. This is what you would have learned in mathematics. Okay, into 10, 20, 30, 40, 50, multiply, put a total, divide by total of 10 plus 20 plus 30 plus 40 plus 50. Exactly same thing we are going to do. Exactly same thing we are going to do. So in now when I'm reaching this stage, at this stage, we're just going to do pure maths. You'll calculate all the 5 numbers. So a question will give a balance sheet. They'll tell you to calculate cost of debt. How will you calculate cost of debt? Approximate method, YTM method, irredeemable, convertible, whatever you have learned, you'll have to follow. Then you have to calculate cost of equity. How will you calculate cost of equity? D1 by P0 minus F plus growth rate. RF plus beta into RM minus RF. RE1 by P0 minus F plus growth rate. They specifically say R realized yield approach. R inverse of P multiple. Then cost of preference. Irredeemable, redeemable, approximate, your YTM method, then retained earnings. Same as cost of equity. Are there some changes? Term loan, what happens? I'll explain. Now I have to multiply with this. What is this? Very simple. Nothing. This is value of debenture. What is this? Value of equity. What is this? Value of preference. What is this? Value of retained earnings. What is this? Value of term loan. That's all. You have to multiply with the values of what? Debenture, equity, preference, retained earnings, term loan, or any other form of capital there. Will all the 5 be there? No, very rarely. We'll have only 1 or 2, or mostly we'll have 2 or 3. Okay, whatever it is. Do the multiplication, divide. Now, in this, there's one problem. I wanted to multiply with the value of debenture. I wanted to multiply with the value of debenture. Now, in the value of debenture, what happened is, I asked what is the value of debenture. I opened the balance sheet. Balance sheet said 10 lakh. And this 10 lakh is nothing but 1 lakh debenture into 10 rupees. 1 lakh debenture into 10 rupees, 10 lakh rupee. I understood. Okay, great. Then it is a listed company. Listed means the trading happens in the market. In the market, this is 12 rupees. In the market, this is 12 rupees. I asked what is the value of debenture. You said 10 lakh. I agree. 10 lakh is the balance sheet value. But it can be listed also. And in listed, it is 1 lakh into 12. There is another value called 12 lakh. Now my problem is, do I use 10 lakh or do I use 12 lakh? Do I use 10 lakh for weighted average or do I use 12 lakh for weighted average? Equity share. In the books, it can be 10,000 into 10. In the market, it can be 10,000 into 50. It can be 50. Preference also can be different. Term loan, normally no trading and all. So book value, market value, everything is same. There is a book value. There's a market value also. Market gives a different. For example, for Bharadwaj Institute, book value, market value, all are same. We don't have any listed and all. So maybe for us it is same. But for many places, there can be a difference between the book value and the market value. Max is saying do weighted average. Simple average, not okay. Agreed. Okay. I don't want to do simple average. I'll do weighted average. But when I do weighted average, you are saying can be 10, 20, 30, 40, 50. Or can be 12, 25, 35, 45, 95, some different number. What do I use as weights? Question says or approach says you can do both. One is called book value approach. Second is called market value approach. problem silent, we do both. What is book value approach? Multiply with the book value weights. What is market value approach? Multiply with the market value weights. Multiply with the market value weights. Multiply with the market value weights. There are certain extra points. I'll touch upon that as we proceed. But you can either do book value weights or you can do market value weights. Source, so the format is first you have to calculate source and cost. What is source and cost is equity, debt, preference, debentures, term loan, retained earnings, and calculate cost for all of that. How will you calculate? Nothing new. Go back to the earlier sessions discussion and calculate cost of equity, cost of debentures, cost of preference, cost of retained earning. So we're going to revise whatever we have done till now. Steps are what? Compute cost of individual components of capital. This cost calculation, I cannot teach anything new. I can only tell you it will be irredeemable, redeemable approximation, redeemable YTM, or convertible approximation, convertible YTM, preference, same story. Cost of equity, 5 different formulae were there. One using dividend growth approach, second one using something called as your CAPM, third one using realized yield approach, fourth one using your earnings growth, which we have not used, and fifth one was inverse of P multiple. Something has to be used and get the KE, KR, KD, KP, and then do weighted average. What is weighted average? Mathematics. Nothing to do with financial management. Nothing to do with your financial management. But for weights, I can use either book value weights. What is book value? Value in my balance sheet. What is market value weights? Value as per the stock market. Value as per the stock market. If you look at in the practical world, the values are obviously different. For example, if I take a company like Tata Consultancy Services, market gives a value of 8,81,149 CR, 881,149 CR, or market gives a value of 2435 per share. In the books, the value is only 296. In the books, the value is 296, but the market is giving a value of 2435. So should I use 296 or 2435 for doing the calculation? Because market gives a different value, books give a different value. Market overall value 881,149. If I look at balance sheet, the equity, capital and reserves put together is some 1,06,000 lakh. 1,06,000 crore. Market is giving a value of around 9 lakh crore. Market 9 lakh. Books of accounts 1,06,000. Like that, debentures can also be listed. Everything can be listed. There's a book value. There's a market value. Which one do I use for weights is the story we have to crack. Any doubts on this? Okay. Now getting back here. So we're going to do source, cost, book value weights, multiply called product, put a total of the product, put a total of the weights and get the WACC. Put a total of the product, put a total of the weight. Is this something new? No, I had explained this. You only told that there will be a weight. You told we have to multiply. You told we'll have to put a total. We'll have to put a total and divide and get the weight. So WACC calculation is nothing but very simple. This could have become more simpler. Instead of WACC, if they could have told me simple average cost of capital, but we don't do simple average. We do weighted average cost of capital. We do weighted average cost of capital, not simple average cost of capital. Any doubts till this? Can we proceed? Okay, now listen. Any asset has two types of value. One is called X, second is called cum. What is this X and cum? Equity share can have X dividend, cum dividend. Debenture can have X interest, cum interest. Maybe you could have learnt this in investment accounting in your accountancy. If you have not done accountancy till now, anyway, I'll explain. Property can have X rent, cum rent. That is the value with the rent, value without the rent. Any asset, there's a X income value and a cum income value. What is this X income value and cum income value? Let us assume I am planning to sell property. The value of the property is 2 crore. This is the real value of the property. But I'm selling it today. I am charging 2.15 crore. I'm charging 2.15 crore. That 15 lakh extra is not my profit and all. I'm still getting only 2 CR only. I'm still getting 2 CR only. But I'm selling it for 2.15 crore. Why is this 2.15? Is I am doing the transaction on, December 31. Another guy is doing the transaction on January 1. Understand the concept very clearly. There's a December 31 transaction and there's a January 1 transaction. When you do on December 31, the owner who buys it will also get the rental income for the last 1 year. He'll also get the rental income. There's an accrued rent. There is a rent is yet to be paid. Rent is yet to be paid. Ownership changes on December 31. The new owner will get 1 full year rent of 15 lakhs. He will pay 2.15 and get income of 15 lakh. Get income of 15 lakh for the last year. January 1 guy will pay 2 CR, get no income of the last year, get income only for the next year. Get income only for the next year. So if a transaction happens on December 31, it will happen at 2.15. If it happens on January 1, it will happen at 2 crore. Now you can't say, no, wait for 1 day, we will get it at lower value. There's no concept of waiting for 1 day. If you buy on December 31, you will get income of 15 lakh also. This income of 15 lakh is not your income. This income is my income. I am the seller. I was having the property for 1 full year. But because I'm forced to sell it, you are buying it, you become the owner and you get the income also. You get the income also. Understand the concept very clearly because concept clarity is very critical. I am selling a property, value of the property 2 CR. When I sell, I'll sell it for 2 CR plus the accrued interest or accrued rent plus the accrued rent. What is accrued rent? 12 months rent which I have not got. January 1, what is accrued rent? 0. January 1, the accrued rent is 0 because rent has already come. Rent has already come. So what concept says is, financial management says, whenever you analyze anything, you should not evaluate at 2.15. The real value of the property is only 2 CR. Where 2 CR will be used? For example, you want to do KE, D1 by P0 minus F. The P0 should be X dividend value. X dividend value. X dividend value. You are doing cost of debenture. Net proceeds. Net proceeds should be X interest value. Net proceeds should be X interest value. Net proceeds should be X interest value. I'll explain again. Whenever we do a transaction in the practical world, there are 2 types of value. X interest value, X dividend value, X rent value. Come interest value, come dividend value. So always use X interest or dividend value in any cost or formula. Wherever you use. You want to do WACC weights, it should be X interest value because that is the real value of the property. The real value of the property is only 2 CR. Transaction may happen for 2.15 CR. So even in your accounting, when you learn in investment accounting, when your interest portion will go to P&L and this will go to this. So the accounting itself is different. You learn this in investment accounting. Some of you would have completed investment accounting. Some of you may not have done it. Maybe you understand better if you have done investment accounting, but doesn't matter at this point. Very simple. Any transaction can happen at X interest value, come interest value. X dividend value, come dividend value. Whenever buying and selling happens, it will happen obviously at the come interest value or come dividend value. But you need to calculate the X interest value, take that to the debit side of the investment value, and the balance will go to P&L. This is what accounting will tell you. Same logic is FM saying. FM is saying that in any formula, what is formula? KE equal to D1 by P0. P0 should be X dividend value. KP equal to preference dividend by net proceeds. What is net proceeds? Issue price minus flotation cost or current market price. current market price has to be X dividend value. Current market price has to be X dividend value. WSEC wants us to multiply with the number of debenture into market price. Book value weights, market value weights. Market value has to be X dividend value, X dividend value, X interest value, X rent value, X rent value. So somebody does it on December 31, pays 2.15. Somebody does it on Jan 1, pays 2. Now the 2 crore guy can't say 2.14 crore. Why did you pay extra? He will say, I did not pay anything extra. I paid 2.15. Immediately got 15 lakh. Immediately got 15 lakh back. Immediately got 15 lakh back. In the practical, if such accrued rent is there, transaction will happen only on Jan 1. They won't wait and all. But I'm just explaining the concept. The concept is a transaction may happen. For example, I may buy a equity share, or I may buy a debenture on December 30, get income on December 31 and sell it on Jan 1. That does not mean you will get 6-month income. You will only get 1 day income that your investment accounting would have proved to you. Clear? Any doubts on this? Any doubts on the concept? So in any calculation, I should use only X interest value, X dividend value, not use the cum interest value, not use the cum dividend value, not use the cum interest value and cum dividend value. This got tested in September 2024 exam. I'll just show you the example and then I come back to that question. Okay. Capital structure, 5 lakh equity share, market price cum dividend. Cum dividend means remove the dividend component. Market price cum dividend. Market prices cum dividend. Cum dividend how much? 75 per share. Company has declared to pay dividend of 6 per share. 6 per share, which will be paid within what? Next 3 days. The 6 is D0, D1. Next 3 days. Paid in next 3 days. Is it D0 or D1? Participate. D0. This is D0. Paid in when? Next 3 days. Immediate payment. Immediate payment. I had explained saying that if it is going to be paid at the end of the year or today, no clarity there, assumption. But next 3 days means what? D0. Company has a history of consistent growth. It has been predicted that company will pay dividend at the rate of 7.59. 7.59 at the end of the year. 7.59 at the end of the year. Rate of dividend growth will be maintained. Cost of equity. Nothing for you to write. Listen. KE equal to D1 by P naught plus growth rate. Dividend will be 7.59. Most important part, price is 75 minus 6. 6 is not flotation cost. 6 is the X dividend value. I'm bringing it to the X dividend value. I'm bringing it to the X dividend value because 75 is what? Cum dividend. What dividend? That extra 6 rupee. That extra 6 rupee. Growth rate is 7.59 is year 1 dividend. What is D1? D1 is equal to D0 into 1 plus G. D0 into 1 plus G. This will give you the growth rate. This will give you the growth rate. D1 is equal to what? D0 into 1 plus growth rate. Very good example this is. That's why I keep saying some of the MCQs are better than even our descriptive question. But I can't solve so many questions because then FM itself will go on for a long time. So D1 is equal to what? D0 into 1 plus growth rate. 1 plus growth rate. 7.59 equal to 6 into 1 plus G. Can you tell me the growth rate? Divided by 6. 0.265. So you use 265, get 37.5%. Get 37.5%. We need to use only X dividend value. We need to use only X dividend value. We need to use only X dividend value. If you use the cum dividend value, that is wrong. Should it only for dividend? No. It is for cost of debenture, cost of preference, cost of equity, or value of debt when you do, value of equity when you do, value of preference. Everywhere only X interest values are relevant. Cum interest value there, eliminate and bring the X interest value. Any doubts in this? Able to understand the question? This came for 2 marks in exam. So like this, Exams may test a basic question in MCQ, or it could be a part of WACC, which we have started now. Any doubts till this first? Let's proceed ahead. Now we may do a proper WACC question. November 22 exam question. Following is the extract of the balance sheet of Measures KD Limited. So this is the balance sheet given. Ordinary shares means equity share. So I need to calculate a cost of equity. Share premium is part of what? Share premium is called what? Reserves and surplus, technically called retained earnings. We may calculate a KR for share premium. Retained profits. Preference is there, you have to calculate a KP. Debentures is there, you will have to calculate a KD. As of now, I find equity capital, share premium and retained profits, which is called reserves and surplus. Okay, for analysis purpose, it's called reserves and surplus. Preference is there, debenture. Ordinary share are currently priced at 39x dividend. 39x dividend. Preference share is priced at 18 come dividend. Debentures are selling at 120x interest. Some is x dividend, some is come dividend, some is x interest. Applicable tax rate is 30%. KD Limited's cost of equity has been estimated at 19%. They are saying you don't take extra effort. KE I am giving you. KE I am giving you. KE, KR both are same. KE and KR both are same. Calculate the WACC on the basis of what? Market value weights. Listen, I need KE, ordinary share. I need KR. I need KP. I need KD. Four things we need. KE, KR, KP, KD. Once we complete this, I'll do WACC. I'll give two answers. One on the basis of book value. Another one on the basis of market value. Both answers we will do. One on the basis of book value. One on the basis of market value. They have asked only market value weights. Okay, they have asked only market value weights. KE, they are saying you don't struggle. I'm giving you directly the KE number. How KE would have been calculated? Maybe D1 by P0, or maybe RF plus beta into RM minus RF. But you need to calculate now KP and KD. That you have to calculate and then do the WACC, which is weighted average using the weights. Any doubts on the question? Working note 1. Computation of cost of individual components of capital. Computation of cost of individual components of capital. This step goes back to what you did earlier. Okay, this step goes back to what we have been doing till now. WACC, no new, just max, purely max has to be done. Cost of individual components of capital. First, cost of equity, no calculation, given in the question, copy paste. Cost of equity. Cost of equity. Cost of equity. How much? 19%. No extra calculation. No extra calculation. Cost of equity 19%. Retained earnings, which I don't think is needed in the question, but I will first complete it and then I'll explain the two approaches to do 19% save. Can you proceed? Okay. Third part is preference. First thing, any information on life of the preference share. Any information on life of the preference share. No, irredeemable. Preference dividend by net proceeds. Preference dividend by net proceeds. KP equal to cost of preference equal to cost of preference equal to preference dividend by net proceeds. Whatever we did earlier. Preference dividend divided by net proceeds. Preference dividend divided by net proceeds. Divided by net proceeds. What is the rate of preference dividend? Keep participating, guys. What is the rate of preference dividend? What is the face value? 8% into 25 into 25. Is there any data about any new issue? Any data about a new issue? Listen, it is in the balance sheet only. But if I have data about a new issue, I can take that into picture. If no information is there, net proceeds is current market price. Net proceeds is current market price. Wait, what is the current market price? 18 come dividend. In this 18, remove the 2 rupee dividend. In this 18, remove what? 2 rupees dividend. What is 2 rupees? Your numerator, dividend. Remove the dividend figure. Remove the dividend figure. In the denominator, 18 minus 2. 18 minus 2. 18 minus 2. What's the answer? 12.5%. 12.5% cost of preference. Any doubts on this? Clear? Can you proceed? Next thing is cost of debt. Cost of debt. Minus 2 is to bring it to X dividend value. The concept which I explained is tested again in this question. Okay. Cost of debt. Okay. Coming to debenture. Any information on life of the debenture? No. Irredeemable. Interest after tax divided by net proceeds. Net proceeds. Net proceeds. How much the face value? 100. Rate of interest 12%. What's the tax rate? Divided by net proceeds, which is current market price, and X interest price I want, which is what is given, I think. X interest price. Denominator X interest price. What's the denominator? 120. 120% means 120% of face value. 120% of face value. 120 into 100 is 120. 120% of face value. Denominator 120 into 100 to calculate the cost of debt. Clear? Equity done, retained earnings done, preference done, debt done. Now we'll have to put it in a WACC format where I have two approaches. One is called book value approach. Second is called market value approach. Question has asked only market value. I'll be doing both. Any doubts till this? Can we proceed? This calculation is the important part. Second is just a formality. Any doubts till this? And whatever I'm doing in working note 1 for every question now onwards will be what we have learned till now. Any doubts on this? Working note 2. Computation of WACC. Of WACC. Six columns. If we do both approach, I need 6 columns. If I do only one approach, 4 columns. Source, cost, weights 2 subcolumn, book value, market value. Weights is to do weighted average, okay? And product 2 subcolumns. Source, cost, weight, product. Source, cost, weight, product. Right, equity, retained earnings, preference debt 19, 19, 12.5, 7. The important part is getting the source and cost correctly. Equity, retained earnings, preference, debenture. Retained earnings, preference and debentures. Can you proceed? Until this. Okay. Book value means copy the value as per the balance sheet. Copy the value as per the balance sheet. What is the value of equity as per the balance sheet? 5 lakh. Equity means 5 lakh. Retained earnings is securities premium. Everything is retained earnings only. 5 lakh. Retained earnings is reserves and surplus. Okay. Better word is reserves and surplus. 5 lakh. How much is the retained earnings? 1 plus 6. 1 plus 6. How much is the preference? 4 lakh. Debt total. They have not asked for book value approach. I am doing just to explain both. Okay. 22 lakhs. Now listen. Product is nothing but cost into the weight. Product is cost into the weight. What we do is we multiply, put a total of the product, divide by the total of the weights and get the WACC. Is it a new formula and all? No, this is mathematics. Okay, so coming to the product column, I'll do market value in some time. 19% into 5 lakh. 19% into 5 lakh. 19% into 5 lakhs. Cost into weight. We are doing book value approach, so cost into book value weight. If you do market value approach, cost into market value weight. 19% into 5 lakh, how much? 95,000. 7 lakh. Tell me the total like we did that. 3 lakh?
20.
20. $320. Clear? WACC based on book value equal to WACC based on book value. This is not asked in the question itself. First, let's complete based on book value. Then I do market value. This is nothing but weighted average calculation. Sum of product by sum of weights. What we do, we multiply them, mathematics, multiply them, get the product total and divide by the total of weights into 100 to express in percentage. Into 100 to express in percentage. Easiest is to do simple average, but that is not allowed. You have to do a weighted average. Three lakh 20 divided by 22 lakh. 320 by 22 lakh into 100 to express in percentage. What's the answer you get? 5?
4.
This is basically the single cost for the entire capital structure. I think 545, round off properly guys, 14.55. Any number above 5 in the third, you have to round off to the higher number. 545, so it will become 55. Any doubts in this? 545 rounded off to 55. What is this 14.55? Average of 19, 19, 12.5 and 7. Which average? Weighted average. The average used is weighted average. Any doubts in this? We have now, you may see that this is what ICAI tests, but this has nothing to do with the financial management. This is basically doing weighted average, which you would have learned in maybe statistics or maths. You have learned there, and we are just following it here. Any doubts here? Can we proceed? Now coming to the market value. I'll go one by one. Listen for some time. Listen for some time. Coming to market value, listen for some time. I don't want you to write anything. What is the book value of ordinary share capital? 5 lakh. So listen, 5 lakh divided by 10 will give me the number of share. And I multiply that with 39. Listen for some time. Listen for some time. 5 lakh divided by 10 into 39. Listen for some time. I don't want any number. I don't want any number. You've been listen more only. 5 lakh divided by 10 into 39. When I go to stock market, if I buy a share of TCS, I am the owner of share capital as well reserves and surplus. Market does not have a separate value saying 39 rupees for share capital, 25 rupees for reserves and surplus. This 39 is the combined value given by market for what? Share capital and reserves and surplus. So what concept says is when you do this, ultimate number you split in the ratio of 5:7. Split in the ratio of 5:7 to get what? The value of equity and value of retained earnings. Market doesn't have a separate value for share capital, separate value for reserves and surplus. If I ask what is the share price of TCS, we saw some 2,400. What is the value of retained earnings? I can't give an answer. I can't give an answer for retained earnings separately. There is a value there. The value is 2435. If you buy the share of TCS and company gets wind up, you will be the owner of equity capital as well as reserves. Reserves will also be distributed to you only. Reserves will also be distributed to you, and share capital will also be distributed to you because you are a part owner of share capital as well reserves and surplus. Part owner of share capital as well what? Reserves and surplus. As well reserves and surplus. Able to understand this? Listen. There are a lot of things to be explained. Divided by 10 into 39. Then you have to do into 5 by 12. What is 5 by 12? Split in the ratio of 5:7. 5:7. Wait for some time. I am not telling you to write. Divided by 10 into 39 into 7 by 12. Listen. In this question, whether you do the split or you don't do the split doesn't matter. Reason is, in the end, you will multiply both with 19 only. In the end, you will multiply both with 19%. Some students split and wrote. Some student did not split and write. Mathematically, same answer you will get. You will get the same answer. So sometimes ICAI does split, sometimes they don't do it. But in case there is a difference in KE and KR, split is mandatory. KE, KR difference is there, split is mandatory. That time I can't say that I will do split or I will not do split. That story will not work. That story will not work. Here, you split. You don't split. Doesn't matter. I am explaining again. Be in listen mode. 5 lakh is the capital. Divided by face value gives me the number of share into 39 gives me the market value of equity and reserves and surplus. Equity and reserves and surplus. There's no separate value for reserves and surplus. You want split in the ratio 5:7. You don't want to split here, don't split. Doesn't matter in this question. Will matter in some other problem. Okay, will matter in some other problem. Wait. Tell me what is the value of preference, book value. What is the face value per preference share? Face value. Divided by, listen, divided by 25. Face value divided by face value. This will give you number of shares. Multiply with the market price. Multiply with the market price. Divide by face value will give you number of equity share. Multiply with market price. Divide by face value. Multiply with the market price. Divided by 25. What is the market price of preference share? It's not 18, it is 16. 18 is cum dividend. As I said, in all our calculation, we will use what only? X dividend value. I'll give you time to write, be in listen mode. First question, I don't want to rush through, you be in listen mode. This is 18 minus 2. Debenture, 6 lakh divided by, what is the face value? Market price, 120. Divide by 100 into 120. If I change the weights, obviously the weighted average will change. I'll repeat again. 5 lakh divide by face value, multiply with market price. Divide by face value, multiply with market price. Divide by face value, multiply with market price. All the three we have done the same thing. Divided by face value, multiplied with market price. Divided by face value, multiplied with the market price. So 5 lakh divided by 10 into 39. I could have written that and 0 in retained earnings also. Because anyway, both will be multiplied with what? 19%. Mathematically, you do 19 into a bigger number or 19 into two smaller numbers. Both are going to be same only. In the end, both are going to be same. 19 into 10 you do, or 19 into 4 plus 19 into 6. Max will not give a different answer unless KE and KR is different. Any doubts till this? Preference divided by face value, multiplied with market price. Debt divided by face value, multiply with market price. Wait, I will give you time. Market value approach, value of equity share capital, value of retained earnings. No separate value in market for retained earnings. No separate value in the stock market. Split market value of equity. What is market value of equity? Divided by 10 into 39 is the market value. This is the market value for equity. That's all. You can't say it is share capital, reserves and surplus. In the ratio of equity and retained earnings. In the ratio of the book value. Is it mandatory to do? Ideally, yes. But if KE, KR is same, whether you split or you don't split does not make a difference. I'm not sure what I've done in my printed answer. So I will prove the answer then. In the printed answer, I have not done the split. Okay. Now we will do the calculation. Our final answer will match. Here I have done the split in the class. Printed answer, I have not done the split. And I am going to prove that both will give same answer because KE and KR is same. I'll repeat again. 5 lakh divided by face value, multiplied with what? Market price. Again divided by face value, multiplied with market price. Divided by face value, multiplied with market price. You get the numbers. For equity alone, 5:7 split. Somebody says, no, I don't want to do the split. I am with you. I have no problem. Clear? Understood? Write this now. You get the market value product, sum of product by sum of weights. Start writing now. It is purely mathematics beyond this. You do the calculation, confirm the numbers once you are done. Don't copy the numbers.
Market value was 2,16,100.
2 lakh
16.
calculation, multiplication. Maybe error is there. Yeah, take it 216 only. Everything else is fine. Total then 452. Okay. Both will give a slightly different answer because the weights are different. The best approach is market value weights because that is what stock market is believing. Our printed answer did not split that RE and equity part, still will get the same answer. Clear? Can we proceed? G Limited has the following capital structure, which is considered to be optimal. Weights, they are giving weights what? Debt is 25% means 0.25, preference 15%, equity 60%. Weights are given in the question, values are not given. Expected net income. What is the meaning of net income? Net profit. Net income means net profit. Net profit. Dividend payout ratio is 30%. If payout is 30%, what else can it give? Retention is 70%. Tax rate is 40%. Entire information just to confuse us. Why? Because then they have said investor expect a growth rate. Growth rate is given. Dividend last year is given. Price is given. Why they gave that above information, I don't know. Why they gave, we have no use. Because what could have been use of that? With that, I divide by number of share, calculate dividend, earnings, all that I can do. But nothing in this question. Last dividend, add the growth on the dividend, divided by P naught minus F plus growth rate. We are not doing, you will do it at home. Okay. Then comes preference. Preference, they are saying, new preference with a dividend of 11%. Can be sold at a price of 95. Can be sold at a price of 95. Any information on life of the preference? Participate. Life of the preference. No. Preference dividend by net proceeds. Preference dividend by net proceed. Debt can be sold. Sold means issued at an interest rate of how much? 12%. Any information on life of the debt? No. Any information on issue price? No. Any information on face value? No. So one option is to assume face value and do calculation. Okay. You can assume face value, then apply the formula called interest after tax divided by net proceeds. Or other simpler way, when you don't give me anything, interest rate into 1 minus tax rate is directly cost of debt. Interest rate into what? 1 minus tax rate. Interest rate into 1 minus tax rate. When you don't give me any other extra information, simple calculation, interest rate into 1 minus tax rate. You are going to do this at home. I am not doing it as of now. I'll just explain, read out the full question. Cost of debt or preference if you don't have any additional information. Preference dividend rate. Debt interest rate, but do into 1 minus tax rate. Do into 1 minus tax rate. You don't give me any extra information. Interest rate into 1 minus tax rate. Preference also you don't give me any extra information. Preference dividend rate. That's all. No into 1 minus tax there. No into 1 minus tax. Can I assume face value? Yes, you can assume face value. Will I get the same answer? Yes. For example, what is the interest rate they have set? 12. I'm assuming face value 100. Okay. So 12% into 100 into 1 minus 0.4 divided by 100. What formula is saying? Listen. Why are you doing this 100? Directly do 12% into 1 minus tax rate. It is not a new formula and all, okay? Where students think I'm teaching new things. No new things. It is just that different ways of doing the question. You want to assume face value? Assume. Into 100 you do, divide by the face value. Into 200 you do, divide by 200. Into 500 you do, divide by 500. Any doubts on this? Once this is done, calculate WACC. For WACC, the weights are directly given. 25, 15, 60. 25, 15, 60. Will it be 2,50,000? I don't know. I don't know the overall capital and all. I just know the weight percentages are what? 25%, 15%, 60%. This can be on 10 lakh, can be on 20 lakh, can be on 30 lakh. Doesn't matter for us. Just use the weights, do sum of product by sum of weights and close the question. Clear? Any doubts on the problem? Any doubts on the problem? Understood the question? I am not doing it. I want you only to do the question. Any doubts here? Can we proceed? Understood? Done? Now, as you practice, because I have not given practice question till now the practice questions are starting. When you practice at home, only concept clarity will come. I am discussing the question because I don't want you to struggle reading a new question. So I've discussed the problem. At home, you have to 100% do it. And then only, because today maybe the practice question can increase also, because till now I couldn't give any practice question. Suddenly you may see 2-3 practice question also. Any doubts on this? Can we proceed? We just learned maybe 2-3 new concepts. That alone I'll tell you. One we learned is cost of debt or preference if you don't give me any extra information. No extra information. Very simple. Cost of debt is equal to interest rate into 1 minus tax rate. Cost of preference is equal to preference dividend. Issue price versus CMP. For computing cost of individual components of capital, we should always give preference to issue price. Issue price can be taken as CMP. Issue price can be taken as CMP. This is an assumption. Please mention this in your exam, that issue price is being taken as current market price. Okay, clear? This is what we have done in many questions. Then, if you have market value of equity given or calculated, how you calculate? Divide by face value, multiply with the market price, split that in the value of equity and retained earnings. Split that in the value of equity and retained earnings. Equity and retained earnings in the proportion of their book value. When can I avoid this? I can avoid this in case KE, KR is same. KE, KR is same. Then for all our calculation, you need to use X interest value. You should not use the cum interest value. You should use X dividend value, not the cum dividend value. For all our computation, whether weights you compute, cost you compute, both the places just take care. Weights also X interest value, cost also X interest value or X dividend value. Then we learned how we do WACC, single cost for the entire capital structure, cost of individual components of capital, which is where my main focus is. Then you do the weighted average, which is a formality. Weighted average is just a formality, just wastage of time, pure wastage of time. Source, cost, weight, product. Source cost is done, weight, product, if you make a mistake, then nothing can be done, because there you just need to do multiplication. Any doubts in this? Then we saw cost of preference also. Preference is same as cost of cost of debt. Only difference is IAT, interest after tax, is replaced with preference dividend. Now the entire chapter, if I want, I can revise it in 5 minutes also. Today's concept alone we have revised, but just keep going through the concept, multiple times you go through, then only things will register. For me, I can, without looking at the concept book, I can tell you what each means. For you, it will take time, so you'll have to go through multiple times the concept book. Any doubts on this? Clear? Done? Okay, we'll end with this.
Now, impact of additional capital on existing cost. Let us understand this. What is impact of additional capital on existing cost? Previous question, the question which we are doing, in the previous session, we have done WACC 18.4. Now, suddenly in this company, let us understand that Tata's invest in equity of this company. The Tata group invest in equity of this company. So equity will increase. I'm just giving Tata's equity, but there's equity only. Once equity increases, maybe people now feel it is less risky. People feel the company is less risky. This 25% may go down to 20% also. The cost of equity can go down, not only cost of equity. Debenture guys are saying we are ready to reduce the interest. Very rare, but debentures are also saying we are ready to reduce the interest because you have brought in a very good company and now we feel risk is on the lower side. Suddenly SBI acquires Yes Bank and now S Bank FD rates will start going down. The S Bank FD rates will start going down because SBI is there on the top of the bank. So whatever we calculated KE, KP, KD in that question, that may undergo positive change, that may undergo negative change. Either ways it can change. It can be a positive change or a negative change. Weights change. One is the weights will 100% change. Why weights will change is you are bringing in one extra weight now, and cost may also change as investor can feel there's an increase in risk or they may feel there is a decrease in risk. They may feel there's an increase in risk or there is a decrease in risk. Classic example, Anil Ambani companies now are considered to be high risk company because he is having lot of borrowing, almost went into the stage of liquidation and all. Now Mukesh Ambani acquires all those companies. People will now feel that is less risky and you will start giving loan at lower rate. You will start giving preference at lower rate. It can be less risky also or it can be high risk also. What is high risk? Suddenly you start borrowing more and more money. If you keep borrowing more and more money in a company, it can push it towards winding up or insolvency. See, if I keep borrowing, today I have a personal loan of 50 lakh. I borrow more. I keep borrowing. At some stage, I cannot repay the loan. At some stage, I will start struggling to repay the loan. So, organizations, whenever they raise new debt, new preference, new equity, there is a possibility of change in weights to 100% will happen. Increase of or your existing component of capital may also undergo a change. For example, in this question, we will do a revised KE if there is a need, revised KP if there is a need, revised KD if there is a need, and there could be a new debt also or something is there. We'll see that. Okay. So there can be a change in any of these. Along with that, there can be a change of a new form of capital which is being brought in. The next concept we are going to learn is called weighted marginal cost of capital. What is the meaning of word marginal? Additional. So, sometime what I can do is I can calculate the cost for existing capital structure, new capital structure. Sometimes I just want the cost for the additional capital I raise. For example, in this question, if somebody asks me what is WMCC, WMCC is 9%. This extra 30 lakh at what rate? Extra 30 lakh only. Do not bother about the existing ones and all. Only that extra. Sometimes what the question can say, extra 30 lakh, 5 lakh debt, 5 lakh equity, 10 lakh preference. For this extra, calculate the WMCC. How will you calculate WMCC? Source cost weight product. Only for the extra capital, only for the extra capital. And if it's only for the extra capital, the value will be same under book value and market value. Reason, if you are issuing a debenture at 110, record in your books at 110. It could be in the form of face value, others could be some premium and other recording. But if you are issuing something at 120, in books also it will get recorded indirectly at 120. So WMCC means weighted marginal cost. Marginal means additional. Weighted marginal. Marginal means additional cost of raising additional money. Cost of raising additional money. Same under which approach? Book value approach or market value approach. What should I do? Identify from where money is raised. The question which we are doing, it is talking about some 10 lakh rupee. From where the money is going to come? See, the money can come from term loan, money can come from debentures, money can come from your sorry preference share, money can come from equity share capital, money can come from retained earnings. Where is the money coming from? Once you have decided that, wherever money is coming, please calculate cost, and whatever you are decided here, cost into weight is WACC. Cost into weight. Weighted average of step 1 and step 2. Step 1 is weight, step 2 is cost. Step 1 is weight. Step 1 is weight. Why? Because it will tell where the money is going to come from. Step 2 is cost. Multiply both. Multiply both. Weight is step 1, cost is step 2. Coming back to the question which we are doing. Question said originally some money to be raised. How much we have to raise? 10 lakh. In this 10 lakh, I have 2,10,000 in the form of retained earnings. They are saying debt equity mix 3:7. This 10 lakh breakup is there. Debt 3 times, equity 7 times. Debt is 3 times, equity is 7 times. In the debt, we have two types of debt. One which has a cost of debt before tax, okay, one which has an interest rate of 10%, one which has an interest rate of 16%. 10% debt, obviously different cost. 16% debt, obviously cost of debt before tax is given. Before tax means interest rate. If it was after tax, directly that is the KD. Whatever equity is needed, it can come from internal equity, external equity. What is internal equity? Retained earnings. Already the para is talking about that. And balance is external equity. Once this is done, you have to calculate a cost of 10% debt. Cost of 10% debt is 10 into 1 minus tax rate. Cost of 16% debt, 16 into 1 minus tax rate. Cost of equity, cost of retained earnings, and then do a weighted average. Then do a weighted average. Requirements, let's understand. They want pattern for raising this money, post tax average cost of additional debt. Average means there are two debt, no, so you have to take a weighted average of that also, not simple average, weighted average. Then cost of RE, cost of equity, and then WACC. The word should be WMCC. They may use the word WACC or WMCC, that doesn't matter. Any doubts on this? Working note 1, pattern of raising additional money. Pattern of raising additional money. Raising additional money. All right. Money to be raised. Center of the page. Money to be raised. Money to be raised. How much? 10 lakh. Split into two. Debt 3, equity 7. Debt is 3, equity is 7. Debt is borrowings, equity is own money. 10 lakh split in that ratio, which is what? 3 lakh, 7 lakh. 3 lakh and 7 lakh. Any doubts in this? This 3 lakh. Can you proceed? 3 lakh is further broken down into, there are two borrowing levels they have talked about. There's a 10% debt and there is a, what is the other rate? Okay. 10% debt, 16% debt. 10% and 16%. 10% debt and 16%. Just give me a net got disconnect. Okay, coming to this, there's a 10% debt and a 16% debt. We are raising 3 lakh. 10% borrowing is there, 16%. What is the 10% borrowing limit they've said? Obviously, I'll want to use it as much as possible. And beyond this, I'll take a higher borrowing, which is how much? 1 lakh 20, 16% debt. 180, 120. So I need to calculate a cost for 10% debt, cost for a 16% debt, and this 7 lakh is broken down as retained earnings, external equity. Retained earnings, external equity. Retained earnings, external equity. What's the retained earnings portion? External equity, 210, 490. 210 and 490. Any doubts in this? This is part 1. Part 2 wants cost of debt, also an average cost, cost of RE, cost of equity, and then finally WMCC. Any doubts till this? Next working note. Cost of individual components of capital. Cost of individual components of capital. Cost of 10% debt. Cost of 10% debt. 10% debt. 10% into 1 minus tax rate. If that given post tax directly, then I wouldn't have done anything here, okay? Into 1 minus tax rate. What's the tax rate? 50%. How much is this? 5%. Then cost of 16% debt. 5 and 8. 5%, 8%. Doesn't end here. I have to do a weighted average of this. What is weighted average? We know. And what will be the weights among the debt is 180 and 120. Among the between the debt, the weights is 180 and 120. Question is specifically asking post tax average cost of additional debt. If they had not asked this, maybe I wouldn't have done. And in WACC, we would have written 4 weights. One is this debt, another debt, retained earnings, and equity. Separately, we would have written all the 4. But here for debt, they want us to club it together. They want us to club it together. Next is post tax average cost of debt. Post tax average cost of debt. Average cost of debt 5% into 5% into 5% into what's the weight of debt? 1 lakh 80. We are doing weighted average, okay? 5% into 180 plus 8% into. This is what we do in a table, okay? Column 2 into column 3. Weight into the cost, product, and then put a total and divide. So whole divided by 180, 120 into 100 to express in percentage. into 100 to express in percentage. 6.2. 6.2. Any doubts in this? 5 into 180, 8 into 120, 120, 6.2%. Can we proceed? Will there be a difference between KE and KR in this question? Why? Why there is a difference? Will there be a difference between KE and KR in this question? Do you see any flotation cost? Do you see any personal taxes? No. So both are same. Anyway, we'll do the calculation, but both are same. Next, cost of K is equal to cost of equity equal to which formula will help us here? Our usual formula D1 by P naught plus G. D1 by P naught plus G. D1 by P naught plus G. Dividend by price plus growth rate. Now listen. In this also there's a problem. Dividend payout is how much? 2. I have not good clarity on whether this 2 rupees is getting paid now or paid later. Word indicates dividend payout. Timing I don't know. Timing is what I am interested in knowing. With the timing only I can decide whether it is a D0 or D1. I am assuming it to be D0 because if I assume it to be D1, I'll get a different answer. D0, I'll get a different answer. Anything is possible, but this looks to be more like a D0. Dividend payout means immediately maybe it is getting paid. D0 means you'll have to add extra 10% on the dividend and then apply in the formula. Understood? Very clear. I had talked about this. We had written a note also separately in your book on this. Okay. Dividend part, this issue will be there. So dividend payout 2 into 1.1, price is 44, growth is 10. Growth is 10. Price is 44, growth is 10. How much you get? Cost of equity is 15%. KE is 15%. Clear? KR equal to cost of equity equal to 15%. KE, KR same. KE and KR is same. KE, KR same. Clear? Can you proceed? And working note 3, computation of WACC, or you can also use the word WMCC. They have used the word WACC. Our usual formula, source cost weight product. WACC, WMCC. Source cost weight product. WACC and WMCC. Source cost weight and product. Now listen. For the calculation, I can write two debt figure, 10% separately, 16% separately, or one debt figure and use 6.2 as the cost. Either ways, you'll get the same answer, whether you write it separately or together. Even equity, separately you can write, together also you can write, because same cost only. Anyway, let us write separately everything. 10% debt, 5%, 180, 16% debt, 16% debt. The weights will come from that initial chart which we prepared. 16% debt. The weights will come from the initial chart. Cost will come from working note 2. You can complete the calculation. Weighted average is more of a formality. Once you are done, you can refer the screen, but that's more of a formality. Do your marking of easy, moderate, difficult, and if you find anything extra points, you can note it. You can highlight it. Can we proceed? Any doubts in this? Understood? Can we clear? Okay, let's come to 45. ABC Limited has the following capital structure, which is considered to be optimum. Capital structure means mix of debt, equity, and preference. Optimum means the best capital structure. Optimum means there is one mix, saying that 50-50, 20-40, 30-40, whatever number, optimum. Debentures are there 14%, preference is there 11%, equity capital is 160, and our capital has 30,000 of debenture, 10,000 of preference share, 1,60,000 of equity share capital. Company has a market price of 23.6. What does this 23.6 mean? P naught. P naught. Next year dividend will be 50% of 2022 earnings per share. We have the earnings per share. Following is the uniform trend of the preceding 10 years, which is expected to continue in future. Year and the earnings per share is next. Okay, year EPS should not be, EPS is the next column. Okay, so year and earnings per share 1 rupee 1.1. If 1 became 1.1, what is the increase percentage? 1 became 1.1, what is the increase percentage? 10. In the calculator, 1 plus 10%, 1.1, again do plus 10%, 1.21 plus 10%, 1.33 plus 10%. This is a rare scenario where every year exact 10% increase. Every year exact 10% increase. If every year exact was not there, what I need to do? Remove all these in between. Remove all the in between. Future value equal to present value into future value factor. Into future value factor. This is year 0. First year not interested, second not interested, third, fourth, fifth, sixth, seventh, eighth, ninth year. Year 0, year 9. Year 0 and year 9. To do what will I need? I need PVF or FVF. I don't need any of this year because every year there is a 10% uniform increase, very rare. Company issued new debenture carrying what rate of interest? And the above table said what rate of interest? Carrying 16% rate of interest. Current market price is 96. Preference share 9.2 with a dividend of 1.1. Calculate cost of new debt, new preference, new equity. New debt, new preference and new equity. New equity comes from retained earnings. Then they are saying calculate marginal cost of capital. Marginal is WMCC. Determine how much you can invest before new ordinary share and new marginal. What is this? Part 3, part 4 I'll explain. First let's do working note 1 is cost of individual components of capital. Listen, cost of new debt means whatever that new interest rate they have given, interest after tax by net proceeds. We'll take our assumption and then close. And preferences PD divided by net proceeds. Equity is D1 by P0 plus growth rate. Equity or retained earnings is same as of now. There's a rework. What happens in the rework we'll understand. Working note 1. Working note 1. Cost of individual components of capital. Cost of individual components of capital. Of individual components of capital. Individual components of capital. Cost of new debt. Is there any information on life of the new debt? No. What's the formula? Interest after tax divided by net proceeds. Net proceeds. What's the interest on the new bond? New debenture 16%. They've said current market price is 96. I'm assuming face value to be 100. Face value to be 100, closer to 96. Okay. 16% into 100 into 100. Why not taking 14% cost of new debt? Cost of new, even if they don't ask also, we'll take new debt only because that is today's cost. Into what is the tax rate? 50. Whole divided by net proceeds is new debt issue price minus flotation cost. Issue price equal to current market price. Issue price minus flotation cost, and issue price is equal to CMP. Issue price is equal to CMP. In fact, everywhere we use only issue price minus flotation cost. We take the issue price to be equal to current market price wherever CMP logic is used. What is the current market price? Into 100 to express in percentage. Let me know what is the cost of debt. 8.33%. Cost of new preference. Cost of new preference. Cost of new preference. New preference. Redeemable, irredeemable. Irredeemable. Preference dividend by net proceeds. Preference dividend by net proceeds. By net proceeds. I think the amounts are given directly there. What's the preference dividend? And net proceeds 9.2 into 100. Now it will become very simple as we proceed. So initially it would have become little hiccups for you, but as we proceeded, the entire chapter would look very simple. 1.1 divided by 9.2 into 100. How much is the answer? 11.9. Okay, 96%. Cost of retained earnings. They're saying what is part cost of new equity, assuming new equity comes from retained earnings. You can use the word new equity, but it's retained earnings only. External equity part 4 may have a different answer. Okay, D1 by P naught plus growth rate. D1 by P naught plus growth rate. D1 by P naught plus growth rate. Something is mentioned about next year dividend. 50% of 2022 EPS. Next year dividend is 50% of 2022 earnings per share into 0.5. P naught is current market price. What is the current market price? 23.6. Growth rate, every year we saw the increase and calculated. 1 year you got the increase and it worked everywhere. Normally they don't give the in between dividend and all. They used to give first dividend, last dividend, and we used to do into PVF or FVF. What's the growth rate? 10%. How much? 15%. Working note 2. Computation of WMCC. WMCC. Okay. Now listen. Have they told how much money are we raising? Every question we did WMCC, they gave money to be raised. Listen. When I went here, I had 10 CR in mind, 5 CR debt, 5 CR equity, 50-50. 50-50 was the mix. Then we had term loan, retain, all that we did. Now, I don't know what money we are going to raise. But one good thing I know about the question is, it said it is a optimum capital structure. So, let us assume I want to raise 1 lakh rupee. If I am raising 1 lakh rupee, the ratio will be 3 is to 1 is to 16. 3 is to 1 is to 16, and we'll give a weight for this. 3 is to 1 is to 16 is the ratio. 3 divided by 3 plus 1 plus 16 is the weight of debenture. 3 divided by 3 plus 1 plus 16. 3 plus 1 plus 16 or 30,000 divided by 2 lakh is the weight of debenture. Whatever you are raising, 30,000 divided by 2 lakh, 0.15. If you are raising 1 lakh, 1 lakh into 0.15 is debenture. If you are raising 5 lakh, 5 lakh into 0.15 is debenture. And if you are raising 10 lakh, 10 lakh into 0.15 is debenture. Weight of debenture is 30,000 by 2 lakh. Weight of preference is 10,000 divided by 2 lakh, and weight of equity is 160 divided by 2 lakh, or whatever we are raising. 3 is to 1 is to 16. 3 is to 1 is to 16. Money I don't know. I don't know what money we are raising. If you tell me the money to be raised, I'll break it into like 50-50. 3 is to 1 is to 16. Multiply the 3 portion into whatever 8.33, the 1 portion into some 11 point something, and the 16 portion into whatever we got now. Any doubts on this? Any doubts on this? Now, right. The point is weights. Weights. Underline that. Weights. Underline that. Weight of debenture. Weight of debt. Weight of debt. And this is a classic question where WACC will use those weights and WMCC will be same. WACC and WMCC will be same. 30,000 divided by 2 lakh. Listen. When we do WACC, what we do? We multiply with 30,000, we multiply with 10,000 and the whole divide by 2 lakh. In the end, we just divide by 2 lakh. Here, every weight I am dividing by 2 lakh. Every weight I am dividing by 2 lakh, and then finally I'll do a weighted average. Next, weight of preference. Preference 10,000 by 2 lakh. 30,000 by 2 lakh. $10,000 divided by 2 lakh. Preference 10,000 by 2 lakh. Rate of equity as of now it comes from retained earnings. The marginal means for additional it is going to come from retained earnings. 1,60,000 divided by 2 lakh 80. Now I don't know what money I'm going to raise. WMCC is equal to 8.33 into 0.15 plus 11.96 into 0.05 plus 15 into 0.80. Whole divided not needed. Why whole divided not needed? Whole divided is 15 plus 5 plus 80, which is 1 rupee. The whole division by 1 rupee. The whole division by 1 rupee. How much money are we going to raise? No idea. No idea, and I don't want to know also. I'm not interested in knowing what money are we going to raise. Able to understand the concept? Any doubts in this? WMCC is equal to WMCC is equal to WMCC is equal to debt 8.33% into 0.15 will multiply in the end round off to 2 decimal 11.9605. In fact, ICAI for WACC also does weights like this and then does multiplication. Answer remains same. I don't do this weight step separately. In the calculator, 0.15 into 8.33%, don't press any other key. 0.15 into 8.33%, 0.5 into 11.96%, 0.80 into 15%, and now press a GT button. Now press a GT button into 100 to express in percentage. The GT button said 0.138475 or 13.85%. 13.85%. Can we proceed? Okay. Now let's understand the part 3 and part 4, which is a new requirement and a slightly unique requirement. Any doubts till this? Understood? Can we proceed? Okay. Now, I always will have a limitation on the retained earnings which are there. It says retained earnings available for next year investment is 50% of 2022. Maybe just add a word there. I think that is missing. 2022 earnings. That word earnings is missing there. 2022 earnings. Okay. Now let us understand what is this. What is the earnings per share in 2022? Listen for some time. We'll write in a minute. Okay. 2.36. How many shares are there? 10,000. So listen. Total earning 23,600. 2.36 into 10,000. Listen for some time. New adjustment, not the usual set of adjustment. In this, 50% is paid out. 50% is retained. Now I want to do a project. If the project is for 10 rupees, 80% has to come from retained earnings. 10 rupee project I can manage with the retained earning. 10,000 rupee project may be possible. 10 crore project may not be possible because retained earnings has a limit. There is a limit to the available retained earnings. There is a limit to the available retained earnings. So we'll first find out how much retained earnings is available and ultimately listen. whatever be the retained earnings I do, retained earnings is equal to 80% of investment. Whatever investment you are doing, 80% of the investment will come from retained earnings. If somebody says, I have 10,000 rupees, I will add some amount of debenture, some amount of preference, and do an investment of maybe 12,000. With my 10,000, I can't do investment of 1 crore. With my 10,000, I can't do investment of 1 CR. I can do some amount because I have 10,000. You are debenture holder, you will give me 1,000. They are preference shareholder, they will give me 1,000, whatever the ratio, and I add them and do an investment. What is the question asking is, what is the amount that you can spend? What is the amount that you can spend before new ordinary share must be sold? New ordinary share must be sold means beyond that limit you can still do investment, but issue equity also, issue debentures also, issue preference also. Below this limit, issue debenture, issue preference, no equity issue, retained earnings is there, retained earnings is there. So this retained earnings as of now is 80% of my investment. What is the investment amount? I have no idea. But I can manage only 80% of the investment through retained earnings. 1 lakh retained earnings, 80% of investment equal to 1 lakh. Uh, 50,000 retained earnings, 80% of investment equal to 50,000. This is the story. This is the story. Able to understand this? Whatever investment we are making, 80% of that will come from RE. Balance 20% will come from debt and preference. To put it very simple, if I have 8 rupees, you will give me 2 rupees, I will do 10 rupee investment. I have my 8 rupees, you both have to give me 2 rupees and I will do 10 rupee investment if I have 8. Let us first calculate how much RE is available, and with the available RE, I can decide how much investment I can do. Beyond that, can I do investment? Yes. For that, issue new ordinary share. When you issue new ordinary share, listen, when you issue new ordinary share, this will change. This will change. When you issue new ordinary share, this will change. And beyond that limit, WMCC will be, this part will change. It will not be 15%. It will not be 15%. Beyond that limit. Beyond that limit. What is the limit? We will decide. We will decide the limit. There are two parts to the question. If you see third part, determine amount that can be spent before new ordinary shares must be sold. Assume retained earnings is, calculate the marginal cost of capital for the funds exceed the amount calculated and see, assuming new shares are issued at what rate? 20. If you issue new shares at 20, KE may go up, I think. If KE goes up, our marginal cost of capital will increase. Able to understand the question? Any doubts in the question? Clear? Clarity is there. Let us proceed forward. Working note 3. Capital expenditure limit, RE and WMCC beyond the limit. WMCC beyond the limit. Particulars calculation amount. Particulars calculation amount. Particulars calculation amount. Earnings per share of 2022. Earnings per share of 2022. How much is the earnings per share? 2.36. Total earnings of 2022. Total earnings of 2022. Total earnings of 2022. How many shares are there? Into 10,000. 23,600. 23,600. Retained earnings of 2022. Retained earnings of 2022. Retained earnings of 2022. There is a limit which we have. How much the retained earnings? 50% of 23,600. Any doubts in this? Now listen. Possible capital, whatever the word they have used, possible, yeah, capital investment with with retained earnings. Possible capital investment, or use the word they have themselves they have used before new shares are issued. In bracket with RE, basically. Basically, with retained earnings, you want to do the investment. You don't want to issue new ordinary shares. With the retained earnings, I want to do the investment. Possible capital investment before new shares are issued with the RE, retained earnings. With RE, retained earnings. Now listen, very simple. Listen for some time. Retained earnings is equal to 80% of investment. What is investment is what money you want to raise. Okay. Why investment is what money to be raised? If you want to invest 1 lakh, you have to raise 1 lakh. So on the asset side, I want to add 1 lakh. In the liability side, 80,000 will have to come from RE, 5,000 and 15,000 will come from the other two guys. RE says I have a limit. RE says I have a limit. Beyond that, please go to new guys. Okay. So 11,800 is equal to 80% of investment. You can calculate the investment and then let me know. Okay. 11,800 is equal to what? 80% of. In the asset side, you can add maybe 14, 15,000. 11,800 I'll give. Balance you both have to give a debt and equity guy, sorry, debt and preference guy, and put together we'll do the investment. You can calculate and let me know. 14,750. This is the limit I have. Okay. Beyond this, RE says I cannot support. Beyond this, retained earning is saying I can't support. I can't support beyond 14,750. Beyond 14,750, please take the help of some other person. Who is that some other person? New ordinary shares. New ordinary shares. Beyond 14,750. This is little unique question. Okay. Beyond 14,750, I will not be able to help. Beyond 14,750, I will not be able to help. Any doubts on this? Can we proceed? Before I proceed ahead, this is one new concept. Optimum capital structure, maximum capex with the retained earnings. Identify the available retained earnings, total earnings minus dividend paid, 50% paid, 50% retained here. Proportion of RE is 80%. Available RE by weight of RE. Available RE divided by weight of RE. Available RE divided by weight of RE. One MCQ example is there for you to quickly check your understanding whenever you are revising. Technically, you have done this concept. No point in seeing that question. There's no major learning in the question once you understand this. Any doubts on this? Can we proceed? Clear? Okay. Next line. WMCC for capex is capital expenditure beyond 14,750. For capex beyond 14,750. Beyond 14,750. If you go beyond 14,750, RE is saying I am not there. Please don't look at me. RE says I am not there. Leave two lines, come down. Leave the table and come down. Two lines. Cost of new equity. Cost of new equity. P1, P naught minus F. P naught is issue price. P naught minus F. P naught is issue price plus growth. Earlier P naught was CMP. Okay. P naught was CMP. issue price minus flotation cost plus the growth rate. Plus the growth rate. D1 number will remain same, growth number will remain same, P naught will undergo a change. P naught will undergo a change. D1 by P naught minus F plus G. P naught minus F plus G. P naught minus F plus G was the D1 number. 1.18. P naught 20. Growth rate 0.1. Calculate now. Cost has increased. WMCC till 14,750 is different. Beyond 14,750 is different. Till 14,750 is different. Beyond 14,750 is different. Any doubts on this? Any doubts on 15.9%? Able to understand this? Now, in the calculation column, show this. Listen for a minute. Show this only changes 15.9. 15.9. Show the calculation and it will become what? 15.9%. 15.9%. Obviously, answer will undergo a change. 15.9%. Again, how much money am I raising beyond 14,750? I have no idea. I don't want to know also. Whatever I raise, 0.15, 0.05, 0.80. Was the answer? 675%. Yeah, 57. Use the grand total function whenever you have to multiply multiple numbers and then add them. In the calculator, 0.15 into 8.33% equal to, automatically will go to the GT total. 0.05 into 11.96% equal to 0.80 into 15.90% equal to, and then press the GT button. 14.57%. 14.57%. Little unique question. Any doubts in this? Any doubts in the question? Can we proceed? Any doubts? I'll give you a minute or two. Go through the solution. Let me know if there are doubts. 2 minutes for. Clear? Can we start now? I want participation. We started with the word capital. What is the meaning of capital? Long-term money. The long-term money can be what? Equity, debt, preference. Equity can be from two forms. What are the two forms? External equity, internal equity. External equity is called equity share. Internal equity is called retained earnings. Then we started with debt. Debt has three types. What are the three types? Redeemable, irredeemable, convertible. Irredeemable debt, what is the formula? Interest after tax divided by net proceeds. Redeemable debt, two things are there. One is shortcut and second is accurate or YTM or IRR approach. Shortcut basically said what formula? Interest after tax plus redeemable value minus net proceeds by balance life whole divided by redeemable value plus net proceeds by 2. When you do IRR approach, year 0 outflow. Year 0 outflow is what number? In that formula, year 0 outflow is net proceeds. Year 0 outflow is net proceeds. For company, it's inflow, but we write it as outflow. Okay. 1 to so many years. What is the inflow for the investor? Interest after tax. Interest after tax at the end of the life. At the end of the life. What is the inflow for the investor? Redeemable value. One rate, second rate, and get the YTM. Get the YTM. Then came your convertible debt. What is the same thing? Shortcut, detail approach. What is the formula for shortcut? Interest after tax plus redeemable value minus net proceeds by balance life whole divided by redeemable value plus net proceeds by 2. The redeemable value is higher of the two number unless it's compulsorily convertible. Compulsorily convertible means only the equity part. What are the two numbers? Redeemer's debt convert into equity. Redeemer's debt convert into equity means the price on the last day into the number of shares on conversion. In this, one discussion is on net proceeds. Net proceeds is if issue is happening today, issue price minus flotation cost. If issue is happening today and they give CMP, they don't give issue price. Issue is happening today, they give CMP. CMP is taken as issue price and do flotation cost subtraction. CMP is taken as issue price and do flotation. Issue happened past, not happening today, not happening today, just the CMP. Just the CMP. Logic is issue will happen today at CMP, no flotation, no flotation. Lot of MCQs are there. Solve the MCQs, you will get grip on the concept. IRR approach I have discussed. Valuation of bond. One is your irredeemable, second is redeemable. Irredeemable, we follow the perpetuity formula. Perpetuity formula basically said value of perpetuity equal to perpetuity amount divided by rate of interest minus growth rate. No concept of growth rate. Perpetuity amount is interest in rupees. Rate of interest is investor yield. Investor yield. Rate of interest is investor yield. Redeemable, same formula you can use, which is called shortcut. R do year, cash flow, PVF, DCF. What is this? We are just adding all the present value, adding all the future values to today and getting the number, discounting and getting the number. Year, cash flow, PVF, DCF. Shortcut, same formula as irredeemable debt. Detailed approach, present value, future cash flow, discounted at investors required rate of return. Likely issue price of bond, interest rate equal to investor expectation, par value meets expectation. Interest rate is greater than investor expectation, premium exceed, and lesser than discount does not meet the expectation. This is on the value of bond. Then we saw convertible debt, same formula, we have already discussed this. Coming to equity, I think we have five formulae. First formula is dividend growth model, technically called Gordon's model. What is the formula? K equal to D1 by P0 minus F plus growth rate. D1 is D0 into 1 plus G. If they give D1, directly take it. P0 is equal to what? Issue price first preference, second preference is current market price when you do your cost of equity. Growth rate, ROE into retention ratio, RR. Present value equal to future value into PVF, or future value equal to present value into FVF. The second is CAPM, RF plus what? Beta into RM minus RF. Third, if they specifically say earning growth model, E1 we have not used in any problem, okay? E1 divided by KE minus G. I am not used anywhere, but I am giving you because it's there in the ICAI material. Realized yield approach means calculate the IRR of the investor. Year 0, outflow of the investor. Year 0, outflow of the investor. 1 to so many years. 1 to so many years, you will get the inflow, which is the dividend. At the end of 5 years, you will get some selling price or 10 years. Discount at one rate, discount at second rate, and calculate the IRR. Take that as the cost of equity of the company. And last part, if P multiple is given, inverse of P multiple if nothing else is working. Nothing else is working, inverse of PE multiple. Then we saw this we have done. Cost of retained earnings is same as cost of equity. Only thing is, in case there are flotation costs, in case there is a issue price and current market price difference, there we take the cost of equity, we take issue price. Here we take the current market price and close it. And that is what CMP is first preference, issue price is second preference, and flotation is to be not subtracted. Flotation is not to be subtracted. Personal taxes is given, KE into 1 minus personal tax rate, 1 minus flotation. I explained one example, and personal tax, one practice question is also having this, okay? One example we have already done, and one practice question is having this. Then cost of preference, same as cost of debt, irredeemable, redeemable, convertible, all the story can happen. Interest after tax is replaced with what? Preference, dividend, everything else remains same. Once all are calculated, do WACC. What is WACC? Cost of debt into weight of debt, plus I can do in the formula also, cost of equity into weight of equity, plus cost of equity, cost of preference into whole divided by all the weights, R do source cost weight product. Weight can be book value, weight can be market value. When we do market value weights, Okay, in all our cost calculation, we use X interest value, X dividend value, X rent value. Nowhere we will use cum interest value, cum dividend value, even for weights purpose or for cost purpose. Weights purpose or cost purpose. Then market value of equity and retained earnings, if both are there, what we do is we are going to get the market value of equity and split that in the proportion of their book values for MV weights. This is critical if the cost of equity and cost of retained earnings do not match. If they match, there is no point in doing the split. Issue price versus current market price. I am making it again very clear that issue price is first preference, current market price is second preference. Issue price is taken as current market price in case you are making a new issue, because there will be some flotation word used there. Cost of debt in case no additional information, interest rate into 1 minus tax rate, and preference dividend rate. If you have any additional capital you're raising, cost of your existing cost of capital can change, weights can change, obviously WACC will change. Obviously, WACC will change. WMCC for additional capital, find where the money is going to come from, cost of all the components of capital, and do WACC's first form into its weight, plus second form into its weight, plus third form into its weight, or source cost weight product, and last one is optimum capital structure is given. How much capex can you do with the retained earnings? Find out the available retained earnings, divide by the weight of retained earnings, or the logical formula I said. Logical is retained earnings is equal to 80% of capital investment. 80% gets divided and you get the answer. Any doubts on this? Took me around 5 minutes to revise this. You keep revising it multiple times, then only you'll get grip on this. Multiple times keep revising it, then only grip will come. Practice, you do all the MCQs. Whenever you revise also MCQs, along with that your difficult questions. You mark your easy, moderate, difficult for every chapter. Any doubts on this? With this, I'll end. With this chapter gets over. Any doubts on this? Done. We'll end with this.